Live from New York City for our audience worldwide. Good morning to you all. Equity futures are positive, up a third of 1%. Yesterday, the biggest one-day drop on the S&P 500, going back about a month to early October 4th to be precise. Your equity market advancing on the NASDAQ 100, up about 100, advancing 0.6%. That's the equity story. Here's the bond market picture from yesterday. We're closed for Veterans Day, but this is what I want to look at just quickly, briefly. The move we had on twos yesterday of about 9 basis points, on tens of about 11. But two stories. Off the back of CPI, we were pricing in, once again, a conversation about higher interest rates, pulling that forward a little bit. We had a big move at the front end. And then, as Lisa pointed out, further along into the day, 1 p.m. Eastern time, we had this really messy, sloppy, soft, whatever you want to call it, auction on the long end. And that's when things started to drift higher at the long end too. So for bond market investors over the last 24 hours, this has been really difficult for a lot of people to get their heads around. So that's the bond market in the US, closed for Veterans Day. This one's open. Switch up the board and get to Europe. Quick look at Italy, quick look at Germany. Germany yields in just a little bit, negative 25. In Italy, off the highs of the last couple of months of about 120, south of 1% at 95 basis points. The Austrian Central Bank governor out this morning, Tom, well-known hawk on the ECB, governing council member, talking up perhaps the possibility of completely winding down bond purchases at the ECB by the end of next year. That conversation is going to pick up in earnest at the end of this year, December, the big meeting for the ECB. So we've got this big 1-2 punch to end the year with, Tom. Middle of December, Fed goes first, ECB 24 hours after. It's going to be very interesting to see what guidance we get on that bond-buying program out of Europe.
Well, the dynamics there, and again, stronger dollar this morning of note, 114.62 on euro. Right now, an important voice on your inflation, Chairman Powell's inflation as well. Julia Coronado is president and founder of Macro Policy Perspectives out of Texas, Austin, and of course, always vetted for a position with the Fed where she's worked for a good number of years. Of course, iconic at BNP Paribas, really talking a tepid GDP a crisis ago. Dr. Coronado, thank you so much for joining us today. You are read worldwide for itty-bitty charts on page 7 where you go, oh, and your O chart this week is old and new guesstimates of rent inflation. What is the dynamic of rent inflation in America?
Well, it looks like we have a hot rent cycle on our hand as well. So we've had a 2 months of prints. It came basically a month earlier than we were expecting, but you know, a lot of the indicators have been pointing in this direction. This isn't a surprise. Of course, calibrating the magnitude is always the trick. So it came in a bit hotter in October, but it looks like we're going to have a surge in rents in the first half of next year, starting now, going into the first half of next year. You know, like many things this cycle, there was a surge of demand early in the cycle. We are seeing a building response, but of course the building response takes some time always, and it's going to take even more time given supply chain bottlenecks. So that's also going to probably be a 2023 issue before we see that moderate back down. So that's adding to the other pressures that were coming, more related to COVID disruptions and supply chain issues that have renewed in intensity because of the Delta variant. So it's sort of a combination of things that look more transitory and things that look more cyclical that are combining to produce some pretty, and the third factor, of course, energy prices. And that really wasn't coming from the global or from the US situation. That's really a, China, European driven dynamic, but it sort of rolls into the US and hits US consumers.
Tell me about the timeline of Fed in waiting for an inflation to turn around and become disinflation. Is it out to January 26th of next year? The Fed meeting of March 16th, or dare I say, can they be data dependent to May 4th?
Yeah, I think they can be data dependent. This is really an uncomfortable situation because, again, the inflation is being front loaded near term. Anything they do today isn't going to have an effect for a year or more. And meanwhile, what we know is in train. We're still surfing this epic wave of fiscal support that will fade over 2022. That money will be spent, that consumers will, demand will cool off to some extent. That's what everybody's forecasting, including the Fed. So, as these forces come together, do you want to pile on to this front-loaded tightening? Do you want to bide your time and wait for some of those forces to play out? It's going to be a tough road a tough balance for the Fed to strike. We do think they will lift off in 2022, but we don't think it'll be till towards the end. We've got to taper. We are putting in a lot of global removal of accommodation, and we haven't yet seen its impact on markets or the economy. And so, I think the Fed proceeds. I think still the bar is pretty high to accelerating a tapering. But, look, the good news is that some of this reflects a U.S. recovery that's pretty darn resilient. As Delta fades, we're seeing demand stay strong, and that bodes well for the staying power of the recovery through this burst in inflation. In other words, one thing you might worry about, and a handful of analysts do, is that this could be demand destroying. This burst of global inflation tends to be sort of a harbinger of recessions. We don't think that's the case because there's just such a good foundation for the U.S. recovery.
Julia, the next stop for this market, as you know, is the December meeting. At that meeting, we'll get some forecasts. We get the summary of economic projections. And I'm just looking at the forecast for core PCE at the Fed for next year. It's 2.3%. I just wonder, from your perspective, Julia, how much does that need to change?
I mean, that's actually our forecast. So it's that is a strong forecast. That's a forecast that includes a very strong rent cycle. But the key there is that goods inflation moderates as the year progresses. So remember, that's above target inflation. That is strong inflation. All it builds into it is that the supply chain issues ease. That semiconductors become more available, that car prices flatten out, maybe cool off a little bit. But all you have to do is have goods prices stop going up at the pace they've been going up to get to that forecast. So it's not an unreasonable forecast. That said, I do think they raised the near term. The current year forecast looks too low. And I do think instead of like half a hike, we do get a full hike in the baseline. It becomes the modal outcome for the committee. And then, steady as she goes. They're going to feel the heat from all the questions, but I think the Fed's job here is to be the steady hand and keep their eye on that medium term.
Julia, the idea of them being a steady hand when it's not as if they're not affecting some of these dynamics. I mean, the idea of rent inflation we're talking about at a time when they're buying mortgage debt, they're buying bonds that actually reduces the yield on the margins of like the loans that people take out, elevating prices. At what point will be staying the course not be adding accommodation, and will they be forced to end the taper sooner? I mean, to me, this is going to be an increasing question, especially since they didn't give guidance as to how much they were going to be pulling back at the beginning of the year yet.
Again, Lisa, I think, if you think about what the choices are here, slamming on the brakes, will that be better than, letting demand run a little hotter for a little longer? What are the pros and cons of these scenarios? I think ideally, if the Fed could calibrate policy, with a fine point in a timely way, they would have been maybe less accommodative now and then more accommodative, towards the end of 2022 when the fiscal impulse becomes a drag. When you model out the fiscal impulse, we've just had this epic impulse, but from a growth perspective, that's going to run out of gas. Even with this new, fiscal packages, these are medium-term, longer-term packages. They don't have anything to do with really the near-term demand profile. So if the Fed could, fine-tune things, they would do a little less now, and then maybe a little more later to pass that baton between fiscal and monetary and smooth the recovery. They don't have that luxury. So, what is the best thing to do? Obviously, if there are signs of, wage price dynamics becoming more entrenched in the economy, they can lift off in June and go pretty steadily. That would be a pretty significant tightening in monetary policy. We can kill inflation. That's not the question. We could kill this recovery. The Fed could kill this recovery anytime they want. That's not what they want to do. If the good news is the other important piece of October data was a really strong jobs report. And that's creating the foundation for the Fed to pull away eventually and hand the responsibility for growth back to the private sector and the labor market organic momentum. And they're in process of doing that, but ripping away stimulus and slamming on the brakes, it probably won't be good for anybody in the global economy. One thing that I think the Fed is well aware of this cycle is that the U.S. is outperforming. We have more support and more momentum than most other countries and regions, and yet we are the keeper of the global currency. So that's a pretty important responsibility. If we slam on the brakes and that hits the global economy, which is more fragile, then that's going to roll back onto our shores as well and destabilize global markets. So that means the U.S. runs a little hotter for a little longer, and that's probably a price well worth paying.
Well, it's certainly running hot right now. Julia, it's going to catch up. Julia Coronado, Macro Policy Perspectives. This the view from Steve Englander over at Standard Chartered. It's as bad as it looks. He strips out the reopening trade, the reopening factors in all of this, removes motor vehicle purchases, rentals, airfares and hotels. Motels, Tom, and he comes out at 5.4 at an annualized pace. It's broader, it's stickier.
Yep.
That's the conclusion for so many people in the past 24 hours.
John, my reading is simple. Watch EM.
Futures up 16 on the S&P, advancing a third of 1%.
Classics. That's it. That's all.
That sounded so random, Tom.
That sounded like the graduate.
That's the point. I don't think it's random.
No, I don't think it is either. It was just random to the anyway. Futures up a third of 1%. We advance 16. From New York, this is Bloomberg.
With the Fast Food News, I'm Rishka Gupta. President Biden admits that inflation's a problem, but he insists he has part of the cure. The president says his soon-to-be signed infrastructure bill is a portion of the plan to overcome the extended effects of the coronavirus pandemic. Yesterday's inflation report showed that prices are rising at the fastest pace in more than 30 years. It's a rare moment of cooperation between superpowers locked in a geopolitical rivalry. In a surprise announcement, China and the U.S. pledged to work together to slow global warming. They agreed to boost their efforts to cut emissions, in part by tackling methane and illegal deforestation. The deal injects new momentum into the last days of global climate negotiations in Glasgow. A federal judge has denied Donald Trump's request that his presidential diaries, call logs, and other records be given to a congressional panel investigating the Capitol riot. The former president wanted the judge to delay an order she issued Tuesday releasing the documents. The National Archives will release the records Friday unless a court orders is not to. In Texas, Governor Greg Abbott's anti-mask crusade has been dealt a serious blow by a federal judge who permanently blocked Abbott's edict banning school mask mandates. The judge says it's a violation of disabled students' right to equally access educational facilities. An apartment rents in Manhattan rose by the most on record last month, according to appraiser Miller Samuel on brokerage. Median rent rose 18% in October from a year earlier to almost $3,400. It's the biggest annual increase in data going back a decade. Many New Yorkers are looking for nicer places to live as they anticipate going back to their offices. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
So you
stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked about other things. Now that's moving to become mandatory.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We have, as we've talked about, plenty of supply for all 28 million kids between the ages of 5 and 11. We have 20,000 sites that are now stood up, with more coming online. So we expect the pace to continue to accelerate across the coming days and weeks.
Jeffrey Zients there, the White House Coronavirus Response Coordinator from New York City this morning. Good morning. Tom Keene, Lisa Bramis and Jonathan Ferro. Your equity market open, underway. Futures advanced 16. We advanced a third of 1%. The US bond market closed for Veterans Day. In Germany, yields are unchanged. A negative 25 basis points on a 10-year. And a stock in the morning, we've got to talk about Tesla. And I'll tell you why. This stock is up by 2.51% in the pre-market. It's well documented that Elon Musk has offloaded $5 billion worth of Tesla stock, but you should not be able to talk about this story unless you also cover the following. And thank you to Anders Mellin for doing that here at Bloomberg. The filings released Wednesday show some of the transactions were prearranged in mid-September, weeks before the poll over the weekend. He also didn't mention in the tweets that he has millions of stock options that must be exercised before next August when they expire. The latter we knew about, Tom Keene, going into that poll. But the former piece of that is something that I don't think you should be able to talk about this story without discussing. A lot of that, Tom, was filed in the middle of September.
I got to be very careful here, John.
Well, I'm reading it verbatim off our story, Tom.
No, he clearly has a different rule book. I don't understand it.
We'll see what the follow-up is.
Yeah, I totally agree. I'm glad you brought it up, John. And I just diplomatically will say there seems to be the rules, and then there's the Elon Musk playbook as well. Let us go to this very important pandemic that we're in. And, of course, pediatric vaccines are front and center. And with Christopher Byrer of Johns Hopkins University, truly one of our international experts, I want to talk about the granted. Dr. Byrer, we walk into the fancy offices that we have, and we don't even look at the syringe. We look at 1860 and on to the miracle of modern syringes of World War II, and we don't even take it for, we just don't even think about the technology that's giving us these vaccines. You have been in the trenches internationally where there is no technology. How do we distribute syringes out to help the millions that haven't been helped like we've been helped in America?
Well, this is one of those examples where we really need to rapidly increase local capacity to manufacture. The idea that this should be a first world product that we are distributing really is a problematic model. The other challenge, of course, is that the Pfizer vaccine and the mRNA vaccines really require an ultra cold chain technology, and that's a real rate limiting step in many countries.
Do you see other vaccines that can help? Johnson & Johnson, I know, in the news in the last 24 hours.
Yeah, easier to use, easier to field, doesn't have the same cold chain requirements. AstraZeneca, also easier to use, not in use here in the US, but in many, many countries. It's one of the most commonly used COVID vaccines. And there are 2 new protein subunit vaccines in the pipeline that also will be much easier to use and field if they prove to be safe and efficacious. Those are the Novavax and the Sanofi Pasteur vaccines.
There's a lot of hope, Dr. Beyer. At the same time, we are seeing the number of cases and hospitalizations plateau in the U.S., rise at a record pace in Germany, and over in Israel, they're having COVID war games to figure out how they can counter a more virulent, a more deadly strain of COVID. Should we be doing more games too?
Well, we need to be doing way more immunization. We still are under 60% of the total U.S. population immunized. So as long as we are at that relatively low threshold, that means about 40% of the U.S. population is not immunized. That's why we're still seeing so many cases and why we're seeing so many deaths. We really need to now address the vaccine hesitancy and the folks who are, still unwilling. I think that's a big part of the reason why President Biden is pushing these mandates, which are constitutional, at least by the 1905 decision of the Supreme Court in the case of smallpox immunization.
The mandates are covering certain companies with many employees. What about for kids?
Well, I think everyone agrees, first of all, that the vaccines really do look safe and highly effective in kids. And the vaccine rollout in kids is going really quite well. There's high demand out there. But it's probably too early to mandate. And remember that the pediatric vaccines are still being used under emergency use authorization. So it's likely that there won't be mandates until those vaccines are fully approved for kids.
Dr. Beyer, I want to ask a really dumb question, and it's something that all of my friends ask all the time. If you have gotten immunized, if you have gotten vaccinated, I should use vaccinated rather than immunized since that's a sore subject, does that mean that you cannot get very sick? How protected are you after 6-9 months without a booster?
So, first of all, it's important to remember that these vaccines were never designed to totally prevent infection. So you can still acquire COVID. What they work so well against is serious disease, hospitalization, and death, and they dramatically reduce the odds of that. There still are people post-immunization who have gotten sick with COVID, these breakthrough infections. Some of that is underlying conditions. You saw, for example, Colin Powell just was fully immunized, died of COVID, but he was on cancer chemotherapy and he was immunocompromised. So those folks are still vulnerable. But what we really have to look at is the comparison between people who are not immunized at all and those who are. And that's really who's filling up the hospitals still and adding up to these still over 1,000 American deaths a day, closer to 1,300. So we're not out of it yet, and we need to do better with immunization. That's the fundamental. We're still in that basic race between the virus and the vaccine.
Doctor, thank you. As always, Dr. Chris Beyer there of Johns Hopkins. Was that an Aaron Rodgers reference there, Lisa?
Oh,
just a little one. It wasn't lost on us.
Yes, of course. He said he was immunized. Everyone thought that meant vaccinated, and
Apparently
I just
not.
did the same thing, but I actually meant vaccinated.
I want to turn to a story in the Financial Times that just got published. Good friend of this program, Mohammed Al-Erin, in the FT, with an op-ed piece, Tom. The Fed's inflation miscalculations risk hurting the poor. I'll read the first couple of paragraphs and then I'll get to the conclusion. Once again, a widely watched inflation data release surprises on the upside. Once again, the underlying drivers of inflation continue to broaden. Once again, it is the most vulnerable segments of the population that are hit hardest. And once again, those who all year long have been characterizing this inflation episode as transitory appear hesitant to revisit their convictions despite consistently contradictory data. go to the conclusion of this. This is really punchy, Tom. Failure to act promptly would turn the Fed's increasingly discredited transitory characterization from one of the worst inflation calls in decades to also a big policy mistake with widespread and unnecessary damage, particularly for the most vulnerable segments of society. That piece, Tom, just dropping.
And the essence of this from Dr. Alarian is his wheelhouse, which is the game theory of all this. And what he's talking about throughout this heated essay, John, is limiting or diminishing the degrees of freedom that they have in decision making. We're
going to keep talking about this one through to the opening bow from New York City this morning. Good morning. Tom Keene, Lisa Abramovitz, and Jonathan Ferro. Futures up 17, advancing 0.4%. For our audience worldwide, it's day 2 of inflation in America after yesterday's 6 handle on CPI. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
inflation is going to be getting worse before it gets better.
The Fed isn't going to make any presumptions about how the future turns out.
The Fed is navigating the most difficult period in its history since the Volcker era.
The measure of inflation really hasn't been very accurate.
We're living in an environment where prices are going to be higher and where wages are also higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The most contentious debate in a long, long time. From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Elisa Abramowitz. I'm Jonathan Farrow. Your equity market futures up 17, call it 18, up 0.4% on the S&P. TK, it's day two reaction to that CPI print.
Well, day two reaction, and Dr. Larian, as you just mentioned, John, really talking it up in the FT here about let's go, and you wonder what the substantial further progress will be to get any given central bank to look at inflation. What, John, double anything considered normal?
TK, people are so dug in on this debate. Did yesterday in that print change anybody's mind about anything?
No.
That's what I want to understand.
Absolutely not. We need to see a sequence of prints. But politically, where it's going to come from, John, is this really strange thing called owner's equivalent rent. You flunk exams trying to explain what it is. Only McKee at Bloomberg understands it. Nobody else really gets it. But I'm going to go to real estate rather than hydrocarbons.
It's going up, Tom. It's going up. And even if you strip out the energy story, it's going up. Lisa, it's stickier, it's broader. And for some reason, a lot of people are finding it very difficult to remain open-minded about incoming data, to shift their view. For the path forward, they have become so dug in on their view. The bias here is amazing.
And the idea is also that we are in unprecedented times, right? Turning the economy off and then trying to restart it. But Julia Coronado is saying in the last hour that the Fed is going to keep a steady hand. And I question what a steady hand means. Does it mean staying the course and incrementally removing stimulus? Or does that mean ending it so that you don't necessarily give a further boost to some of the inflation pressures, particularly in the housing market?
We got a lot to get through. Let's start with the price action for you. Equity futures up 0.4%, call it a third on the S&P. And the bond market, remember, we are closed for Veterans Day. At the close yesterday in the bond market, 155 on 10s, a big repricing off the back of a sloppy auction, Tom. It wasn't just down to that CPI print. At the long end, it was about a rough issue that came from the Treasury.
Yeah, and again, I'm going to go to the flows theory. I think George Saravelis at Deutsche Bank, John, really emphasized this 2 weeks ago, say maybe 10 days ago, that so much of this bond movement is about huge movements of money and bets in the market.
And do we need to get used to this? Euro dollar with a 114 handle. Lisa?
I think it's a huge
114.69.
Yeah.
Negative a tenth of 1%.
And how much will you see that continue in terms of a trend with the dollar strengthening the most to the strongest versus its peers going back about a year? Today, as you were mentioning, John, the U.S. cash bond market is closed for Veterans Day, but I really want to hone in on that 30-year auction yesterday. Just to give you a perspective, that where the yield priced, where these bonds sold, the yield was 5 basis points higher than where it was trading before this auction. There has not been such a significant mispricing going back to August 2011 when the United States was defaulting. Just to give you a perspective on how messy it was and what Jim Caron said, it was one of the scariest ones he's seen. And frankly, it shows this incredible mispricing of risk on the long end. At 8:30 a.m., we can pick up on that as well as the wealth tax and a host of other issues. Omega Family Office Chair, Chief Executive Officer, and Founder Leon Cooperman will be joining us here on Bloomberg Television. And at 11:15, President Biden is speaking in the Arlington Cemetery about Veterans Day. I am wondering, though, whether he talks at all about the CPI print yesterday. This is incredibly political. How does he reframe this? Connor Sen, an economist, yesterday said there was a huge shift, John, in the Democrats' rhetoric, where suddenly they were acknowledging inflation and trying to work with it in a new way rather than just say it's transitory. The mood has shifted, John, and so does the political rhetoric have to as well.
Do you think that some of the economic analysis is political as well? One thing that I noticed with the previous administration, and many other people talked about it too, a lot of people found it hard to divorce their political bias away from their economic analysis. And I just wonder to what degree, to what extent that's happening again.
Honestly, how do you parse the two out from one another? Because the political response is what do you do with data? How do you interpret it, right? I mean, this is a very tricky thing. How do you move forward and try to combat this? Ultimately, it comes down to faith because we don't know how quickly some of these inflationary pressures will roll off, John. I mean, I'm just being honest when I talk to economists. You know, their political view is related to their view on economic inputs.
I hear a rumor that Anne-Marie is in town. in New York City, and she's going to join us in about 10 minutes on the situation down in Washington. I've heard a rumor, Tom. She might be showing up.
She's in New York?
She is in New York City.
Oh, the Gucci sale. Oh, yeah. Okay, I remember. Yeah.
Or has she gone back to D.C.? We'll find out in 10 minutes' time. Yeah. Kristen Bidley joins us now, Regional Head of Investments for North America at Citi Private Bank. Kristen, let's start with the inflation print from yesterday. A lot of people have become married to their view on inflation, transitory or otherwise. Are you flexible on yours for next year?
I think we have to be flexible, and I think we also have to really define what transitory means, or maybe just stop using it entirely, because I think what we're going to see is, yes, we saw a pretty spicy CPI print. Our view has been it's actually very nuanced, right? So we should anticipate seeing these elevated levels of inflation, and we should anticipate seeing them for the next couple of months. What happens next year is really very contingent upon the demand side of the equation, and I don't think we talk enough about this. So we expect inflation to be elevated. That's different than transitory, but it will moderate to around 3 to 3.5%. And we see a lot of that relief coming more from the demand side. And the reason for that, part of the demand is obviously seasonal in nature going into the holiday season. The other part is when we look at the consumer savings rate, the consumer is very liquid, very strong, but that big spike that we saw in consumer savings has really come off substantially since the discontinuation of stimulus checks. So once you have a normalization of consumer demand, that's going to help really match the demand and supply and get us to that 3.5% average, which is still elevated.
Kristen, you're out of Kellogg in Northwestern, and that means you've studied management up, down, and sideways. Is your study that management in America can adapt to this inflation?
I think we've seen that actually throughout earnings season. So the one thing is, as we're talking about all of the market impact of what happened with the CPI print, kind of that moving up of potential rate hikes, we've actually seen in earnings season, the way to beat higher rates or to beat inflationary pressures is with record high profitability. It didn't happen across the board, but it was pretty impressive. And so what's going to continue to drive markets is getting away from some of the momentum trading that we've seen, getting away from whether it's COVID winners, losers. We're no longer about that. It is about a return to fundamentals and what companies have strong balance sheets, the access to capital, and the ability to continue to grow earnings, which is where we're invested.
Kristen, how do you price fundamentals at a time when the technicals are a bit, shall I say, distorted?
Yeah, distorted. That's probably a great word for it. I think, again, we have to approach this in terms of the fundamental argument. We have to break down short-term versus medium to long-term. Short-term, I think if you are a short-term tactical trader, you have to approach that with a lot of humility, because it is difficult to predict these economic prints, and it's also difficult to predict the market reaction on the back of it. And so in terms of looking at fundamentals, what we're really trying to do is pull back from the prediction and actually just preparing our portfolios for this type of environment. So regardless of whether inflation is at 3.5% average, or whether it's elevated, or whether we get a rate hike over the summer, you want to prepare then for a higher rate environment, and you want to prepare for those inflationary pressures, which means we're pulling back from duration and we're finding alternative sources of yield in the portfolio. And I think that's really critical.
Kristen, I think you're so right. Getting the call on the economics is one thing. Getting the call on the markets, quite another. In the last couple of weeks, tremendous ISM in America, really solid data, great payrolls report. And then this 6% print on CPI north of that at 6.2. An equity market, let's be clear about it, is still just off all-time highs. It's very difficult to understand whether this will persist. The number one theme of this year for us, Tom Keen's pointed it out a million times, corporate America has just adapted to the cost pressure. Can they keep repeating the act, Kristen?
So can they keep, I think it goes back to, again, delineating between companies and strong balance sheets. Can they keep repeating the act? Not all companies can. Right? So this cost pressure overall, we've seen that, and we saw that in earnings. We saw the ability to pass that through. We've seen certain parts of the market actually penalized for that. So looking at sectors like consumer staples, I think taking a step back though, and really this nuance, can risk assets sustain this type of pressure? And we have to look through to, again, strength of the balance sheet, access to credit. And we also can't completely abandon tech in this, because there is strong growth that is coming out of tech. And not all tech is created equal. This is a very diversified sector with long-term secular trends that have the ability to grow. So cybersecurity is a great subsector of tech that will have this ability to grow just given the secular trends and flows that are coming into what is actually a pretty brand new sector.
Kristen, thank you for being with us this morning to work through some of these issues. Kristen Bidley there of Citi Private Bank. Tom, it's a tough market to get right. Bottom line, we're up 25%.
Yeah,
over the last year to date.
Thank you, John, for mentioning that. And you look. I haven't done the math. I'll do it on the break here, John. It's easy to do on the Bloomberg. The cursor can calculate the annual return literally with one click. But John, I would suggest that in this great 3-year bull market, the percentage of people that have underperformed substantially or just flat out missed it, it's jaw-dropping.
Yep. Too many people, Tom. Too many people. How many people have come on this program, Lisa, and talked about remaining active, and passive's worked out?
And honestly, part of it is due to the big tech names. I think about Alphabet. It's up nearly 70% year to date, just to give you a sense of how much that has driven the rally. And then the behemoth that it is, what happens if those players are not in the mix, if they underperform? This, I think, is one of the biggest questions heading into 2022.
Coming up in the next hour to weigh in on all of this in the 8 o'clock hour is Mandy Zhu of Credit Suisse. Looking forward to that conversation. Just to give you a feel of the price action this morning, futures up 18, advancing 0.4%, a lift in this equity market, bouncing back from the biggest one-day loss since early October. Into the bond market, we are closed for Veterans Day. In the US bond market, we are open in Europe. In Germany, in the bond market, unchanged, yields negative 25 basis points, setting us up really quite nicely in December for the final 2 meetings of the year from the ECB and the Federal Reserve. Look out for the forecast from the Fed. Look out for the policy decision from the ECB on the what next of their bond buying. From New York City, from radio, from TV, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Xi Jinping has delivered the first doctrine on Communist Party history by a Chinese leader in 40 years. That gives him the mandate to potentially rule for life. Only Mao Zedong and Deng Xiaoping have authored a so-called historical resolution, and both used them to dominate party politics until they died. Inflation in the US make it worse before it gets better. October's annual rate was 6.2%, the highest since 1990. Key drivers of higher prices, such as the hot housing markets and a global energy crunch, show few signs of fading away soon. That could threaten President Biden's spending plans, and it may pressure the Fed to raise interest rates sooner. Tesla CEO Elon Musk has sold $5 billion of shares in the electric car maker. That was shortly after holding a poll on Twitter on whether he should sell 10% of his giant stake in the company. The world's richest person has sold more than 4.5 million shares this week. Those were his first sales since 2016. And shares of Disney are lower today. The world's largest entertainment company reported a smaller than expected increase in subscribers to its namesake streaming service. That was only part of a broadly disappointing quarterly report. Disney sales and profit both missed estimates. And in South Africa, the last president of the apartheid regime has died. F.W. de Klerk took power in 1989. He removed a ban on the pro-democracy African and National Congress, released Nelson Mandela from jail, and managed South Africa's first all-race elections in 1994. He and Mandela were awarded the Nobel Peace Prize. F.W. de Klerk was 85. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they're needed most.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Where's the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Inflation is higher. It's eye-popping. This is a transitory period. That's what we believe. That's what I think when I look out at the data. But it's directly related to COVID. And as quicker we get through COVID, the better off we're going to be as an economy.
The T word again. San Francisco Fed Bank President Mary Daly. You will not get away from it. From New York City, Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market up 16, advanced at 1/3 of 1% on the S&P 500. Yields unchanged on bonds, closed in the Treasury market for Veterans Day, Tom. Euro dollar, hard to get used to this one. Haven't seen it for a while. 114 on euro dollar, 114.73.
John, what's the ramifications of 113 weaker euro?
Weaker euro, if they're worried about inflation, Tom, and I'm not sure they are yet, obviously it could have some consequences. This is about bond buying right now for the ECB, Tom. How much flexibility will they carry over from the emergency bond buying program over to traditional bond buying and through most of next year?
As we mentioned, and Hilarion alludes to this, just it shrinks down the degrees of freedom, the wiggle room, and it'll be interesting to see the Fed cadence to the December meeting. Right now in Washington, back from Baltimore, Amory Horton with the president and our Bloomberg Washington correspondent. Amory, Jeff Stein in the Washington Post, I don't know if you've seen it, but in the last hour, he publishes an article on the inflation reality. I've lived it. When you have inflation and your income goes up because of inflation, your taxes go up as well. What's the new tax policy in 6% inflation America?
Well, the president was talking about the fact yesterday that there is wage gains and all of this growth, but you hit the nail on the head in the sense that, okay, if you're making more money but prices are higher, you are net not coming out on top. And that's really what this administration is facing as they try to go around the country and tout this win, which is the hard infrastructure, and punt to why they need that bigger human infrastructure spending, tax and spending plan, that they are going to be dealing with the everyday concerns of rising, not just energy costs, but food, shelter, rent, everything is going up. And that really overshadowed the president's speech yesterday.
Well, it overshadowed it, but then the idea here is you've got to get to a tax policy. And, you know, the gentleman from Massachusetts, Mr. Neal, and the House Ways and Means is going to have a lot to do with that. How important is the CBO report the moderates are waiting for our new higher tax bills?
Well, the CBO report, we're getting a little bit of tricklings for it, but it's not on the big ticket items. And potentially they want to vote next week if the rest of that CBO report comes. But we have to wait for that data to come in. And that will be key, Tom, for those moderates to sign up and vote yes on the Build Back Better agenda. The issue right now the Democratic Party has with trying to move that forward is the CBO score could potentially take longer than just next week. But it will be key to make sure that that upcoming bill is fully paid for, as the Democratic Party says.
Meanwhile, the response to the higher inflation read is evolving in Washington, D.C. And Connor Sen, a Bloomberg opinion columnist and economist, said today was the day D.C. Democrats stopped treating inflation as transitory. Do you agree? And how significant is this?
Most are stopped treating it as transitory. There's a lot of concern, and it's from the likes of Senator Joe Manchin, which we've spoken about, and that was also very obvious. He's been voicing his concerns about inflation and saying yesterday that it, in fact, of course, is not transitory. But then you have climate hawks like Senator Warren, Senator Markey coming out and saying that the administration needs to do something to ease consumer concerns when it comes to gasoline prices. And they're calling on either an SPR release or an export ban. So you are seeing it on both sides of the Democratic Party. It's just different in what they want the reaction to be. So the progressives, of course, could want to move ahead on Build Back Better, but potentially want some temporary easing on American concerns, while potentially you have Senator Manchin that's going to use this inflation print as a way to slow down or potentially take some money off the top line of the larger fiscal spending plan they have for the human infrastructure side.
Anne-Marie, when do we get a Fed chair decision? How long do we have to wait for that?
You ask me every day.
I'm going to keep asking every day until we get one.
If I knew, I probably wouldn't be doing this job. But I think the timing of, this inflation print is making it much harder for the administration, because it's not just the top chair position they have to fill. If they change Powell up, that's 4 positions they have to fill at a time when they are dealing with serious inflation concerns amongst the electorate, and potentially they're going to get called out for this.
This is where it gets interesting, Tom. Do they have to offer up some kind of package to get some confirmation? Do they have to have a voice within that package that has some credibility on inflation, perhaps someone a little bit more hawkish? If you'd done this several months ago, it might have been easier, Tom, but here we are.
Yeah, okay, I'll go with that. My experience in this, John, is it's a presidential decision. He's going to make a decision, and that's it. We move on.
I agree with you, Tom. And I said that about the last president as well.
Yeah.
It's up to him. But ultimately, the longer he's waiting, the harder this gets, Tom.
How do we pick the Bank of England governor?
The Treasury.
The Treasury picks it, not the Prime Minister.
Well, I imagine there's a conversation there, Tom, yeah.
The Queen?
The Queen, no, the Queen does not weigh in.
Okay,
the Queen does not weigh in.
Know. Harry Kane? I don't know.
Harry Kane doesn't either. Thank you for making this one a little bit more humorous. Anne-Marie, thank you.
I'm trying.
We'll let you go. Anne-Marie Horden, thank you very much. Tom, it's late. Bottom line, it's late to be naming your Fed chair, and it's getting a little bit more consequential as the months go on.
You dismissed Anne-Marie so rudely, but John, hasn't this administration been late sort of on everything?
Well, I thought Anne-Marie would be
ambassadors
in New York, but it turns out she's in D.C. Yes, they have been.
Yeah, Gucci has a sale
They've
across
been
the square.
late on a range of issues, but on this one particular issue, inflation hasn't faded this year in the way that people thought it would, and Lisa, that complicates their ability to get through whoever they would like to get through.
I do wonder, though, if it's too late to try to confirm anyone other than Jerome Powell. I mean, basically, he's got to get confirmed, or someone's got to get confirmed by February, and you have a very split Congress, a very split Senate. Senate has to weigh in on this. All 50 Democrats have to get on board if you want to get through a more progressive type of candidate.
Can you imagine what those confirmation hearings are going to be like, Lisa?
They're going to be contentious this time.
Given the data that we just had yesterday.
They're going to be really contentious. How do you stay the course? This is going to be a very difficult one to get through, and we don't have much time.
We don't hear much about Vice Chair Clarida, Tom. Really not heard much about him at all. That's just not really part. And that's kind of this divide between Wall Street and, say, Washington, D.C. On Wall Street, if you speak to people in markets, they really want to understand what happens with Vice Chair Richard Clarida, because he's been a guiding light for policy, the reaction function of the Federal Reserve. It's just not part of the conversation right now.
Yeah, and let's remind ourselves, he's a front-rate academic on what's called DSGE, which is the underlying theory of the dynamics of modern monetary theory. And there's others there that can do that. Dr. Coronado, who we had on earlier, is fluent in that as well. But John, I am surprised at his less visible presence.
I do wonder, John, and we have to keep having this conversation, how much the Fed really has control over this inflation. In other words, to what degree are they responsible for some of what we're seeing versus really it's out of their hands?
And that's the difference between politics and economics, right? And so much of this at the moment is political. And that's the problem. Are you forced into making a political decision that doesn't make much economic sense?
Especially when it's hard to parse that out, even on an economic level. So you put the politics on top of it, and it gets just super muddy.
Need a man who's got an opinion. Peter Cheer has an opinion. He joins us from Academy Securities. He joins us next from New York City. Futures positive 0.4%. Let's call it a third. Yields unchanged on German bonds. Your Treasury market closed for Veterans Day. From New York, this is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year. Yeah. And so our approach is, is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
I was just finishing what you were saying, Tom.
Thank you.
November 3rd
You did
when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here. Lunchtime, the biggest one-day loss on the S&P 500 since October 4th. We advanced a little bit, up a third of 1% on the S&P, advancing 17 points on the Nasdaq 100, up about 100, advancing 0.6%. This is your little bounce back after the inflation surprise of yesterday. Inflation in America with a 6 handle, the sticker shock got everyone's attention. Let's talk about the bond market. Closed today for Veterans Day. Switch up the board and get to Europe. The bond market backing away from zero again. It was in and around negative 10 basis points at the start of November. It backs away to about negative 25. In the Italian bond market, about 95 basis points. We were as high as 1.2% through that level, through 120 in the last couple of months, and we back away again. December's going to be absolutely fascinating. On the 15th, the Fed decision. On the 16th, an ECB decision. And then you can call it year over, unless, of course, there's a negotiation in D.C.
Excuse me, John, for you, it'll be years over. You're going to be on Capri.
Year is over. I'll be getting the flight after the ECB decision. Switch at the board and get to euro-dollar. Euro-dollar, the shape of things as follows. How do you push through the potential for divergent monetary policy, if that is indeed how things evolve through the next 12 months? Euro-dollar at the lows of the year. We have a 114 handle, 114.69 TK. It's a weaker euro in the mix again this morning.
Very good. On this day of remembrance, in here with the equity markets moving and bond market closed, really, really interesting. John, how does the stock market move with the bond market closed?
We don't get those worries, those jitters off the back of sloppy auctions like we got yesterday.
Should the stock market be closed today?
Yes.
Thank you.
Because then we'd get off.
Thank you, Lisa.
No, it's a disgrace.
Come on,
it's a disgrace.
Do you think it is a disgrace, Tom?
Yes, I do. It's absolutely dumb. I mean, I don't know what Romaine thinks about this, but come on, the bond market's closed. Take a day off.
I don't know if he's as fired up as you are right now. Take a breather. Euro-dollar 114.69, down a tenth. That's the cross-asset price action. Let's get you some single names, some movers this morning, and say good morning to Romaine. Morning, Romaine.
Hey, good morning, John. And yeah, Tom, the market, at least the equity market, is still open here. Moving this morning here, Disney, probably the big disappointment of the day. In fact, it's probably been one of the bigger disappointments on a yearly basis as well here. They came out with their earnings here. Obviously, everyone was focused on Disney Plus. They got up to about 118 million subscribers. That was well short of what the street was looking for. Remember, they have a goal here of getting to 260 million subscribers by 2024. So you got to basically more than double off of a $100 million base, 100 million person base right now. To get to that, Bob Chapek basically says, don't worry. They're going to expand Disney Plus into new markets, international markets. They also have a new slate of products coming out, content coming out that should help them achieve that number. But this is a company right now that is now running a huge loss in that direct-to-consumer business, and that's a bigger concern here as well. That loss was much more severe than what the street was looking for, and Bob Chapek basically made it clear they're going to spend a lot more money to achieve what they needed to achieve. Then there's the whole ballast of the parks business. That was supposed to be what was supposed to help them. They actually had a much smaller profit than what the street was looking for. A lot of that because of concerns about what's going on in their international businesses. The idea that some of those international parks didn't have as much of a smooth reopening as the parks here in the U.S. Anyway, you add it all up. This is a company really being battered now by slower growth and rising costs here. We'll see how this all shakes out. Tesla, here's how it's shaking out. Up for a second straight day. Confirmation that Elon Musk did indeed sell some of those shares here. Keep an eye on the put-call ratio here. That's been creeping up higher, and a lot of the short interest starting to come back into the stock. And Beyond Meat, a huge disappointment off of the earnings last night. Down 19% here in the pre-market. It was already down 50% prior to today from its all-time high. Flip up the board here. Let's take a look at Open Door Technologies, which pioneered that iBuying business, that iBuying technology. That, of course, felled Zillow last week. Is not really felling the Open Door. They reported earnings. They seem to be doing okay with their algorithms. Beazer Homes unchanged here on the day. Of course, they make a lot of entry-level homes here. And Affirm Holdings up about 26% here in the pre-market. Wow. They reported earnings. The EBITDA was actually very disappointing, but they actually talked about an expansion of that relationship, guys, with Amazon.
That'll be fascinating to see. To me, Affirm is game-changing. And I'm clear, I don't own. I wish I owned shares, Romaine, but
yeah, it's never too late, Tom.
I'm in the triple leveraged all cash. I'm looking for an entry point. Romaine Bostic, and with a close this evening as well. It is Veterans Day, and there are firms that are each indifferent, and they all have military types running them, or military types as employees. No one does it, though, like Academy Securities. Chance Mims and the team with a board that is heavily military-based, including General Tata, even though everybody seems to be from Annapolis, And on this Veterans Day, we are thrilled to welcome their head of global macro strategy, Peter Cheer. Peter, what is different about Academy Securities? Explain, not on Veterans Day, but the day-to-day difference of your shop with its military San Diego background.
You know, it's a really fun and interesting place to work. So our entire C-suite is veterans. About 50% of the firm is veterans. And they instill kind of a behavior and expectation of, you know, how to act. And it's really good. We still have firm-wide calls to make sure that everyone's informed on what we're trying to do. And it's responsibility of the non-veterans to mentor veterans. So my job is always to work with one or two veterans and get them up to speed on how Wall Street works and find good roles for them. So it's really neat to be part of that overall challenge. And then on top of that, we have 14 retired generals and admirals who serve as our geopolitical intelligence group. So we get to plug into them. And that's really helpful for what I do. There's some stuff that's very geopolitical focused, but there's a lot of great overlap. And it's been super helpful in analyzing what's going on with China and now Russia, Saudi, what's going on with oil. So it's been a really fun and interesting place. And to watch the growth trajectory has been awesome, and I'm lucky to be a part of it.
Okay, so you're going to brief General Tata this morning. Let's describe this inflation, Peter Cheer, and what it means for retirees, what it means for pensions. Does cost of living keep up or not?
I think this inflation is a multi-year process that we are working our way through. I think two things that have significantly changed that people are just starting to dawn on are, one, China had been an agent of deflation for years, if not decades. That has changed. I don't know that they're actually going to be inflationary, but I don't think they support the deflation story any longer. And then the other part is this transition to ESG is really inflationary. So right now, Europe's particularly dealing with underinvestment in traditional energy, so that's going to be spending. But when you look at anything coming out of COP26, our own infrastructure budget, there is going to be a lot of spending and build out to get us on a sustainable energy path. That is going to be inflationary. So I think this is a multi-year thing that we have to deal with. And so far, no one's coming to that realization, though more and more people are creeping that way. And COP26 seemed to solidify at least the ESG as inflationary argument for many.
Probably the strongest way that perhaps you are presenting this thesis in markets is your outright short bet on 30-year treasuries. You said over the weekend that you actually believe that this is the way to go. Yesterday seemed to edify that with a pretty strong move after the really messy auction. How much further does it have to go?
You know, I think we should see the 30-year back above 220. I'd like to see the 10-year towards 170, 180. I think right now there's this balancing act. We saw a little bit of it occur yesterday where when CPI hits, the front end yields go way higher and the back end doesn't respond much. If anything, we got a very significant flattening because I think people still have this expectation that the Fed is going to hike and that's going to slow down growth. I think the Fed is going to pound into us over the coming weeks and months. They are not going to hike, which means the long end of the yield curve has to bear the brunt of this inflation pressure. And I think that's the next wave. So this is all very difficult to trade right now because there are, as Bloomberg points out almost every day, new stories about macro fixed income hedge funds getting in trouble. So there's a lot of noise within this trend, but that's the trend I'm looking for.
Pete, this is a really interesting thesis because a lot of people will say if the Fed does hold on and doesn't raise rates, then what you get is they will have to raise rates more quickly down the line. They will have to respond and curtail growth more dramatically, and that could actually lead to even lower long-term rates. Why do you push against that?
Partly because whether it's Powell or whoever else is chair, I think the decision is if I hike today and the economy slows, everyone's going to look at me like I was insane and I slowed the economy. So I think no matter what their models say, no matter what pressure they get, deep down, it is very difficult to be the one to hike. And he's told us over and over again, right, that first they're going to be done tapering before they even think about hiking. And somehow the market kind of refuses to listen to them. I think the market has too many people who grew up with a different style of Fed, a Fed that had a different reaction function. And this is a new Fed, it's a new reaction function. And they are willing to let things run hot because they're too scared to be the ones who slow this down.
Pete, Chairman Powell, does he get a second term?
I think he should. I think he's done a very good job. I think he managed us through the pandemic. And one thing that doesn't get talked about enough, in my opinion, is he actually tried to hike rates. He tried to normalize, and he had to back off. So he's got some experience with the attempt to normalize. So I'm not sure why you bring in someone new. And when we talk about, oh, we maybe need someone more progressive on the Fed, first, I'm not even sure what progressive on the Fed side would mean. I think the Treasury Department's supposed to be progressive. If we want to do progressive policy, change things around, that's the, Treasury's job. The Fed has a mandate. We should stick to that mandate. And Powell's done a good enough job, has the respect of markets. I think it would be disruptive to replace him.
John, you know, this is important. Peter Cheer, Academy Securities, with all they do for military, some really important service there. John, it says surveillance road trip, March 31 of next year when the Padres open against the Giants at Petco Park.
Why is everything a stop on the global tour of Tom King?
We can fold in here Peter Cheer, who's always interesting.
Fantastic.
Chance Mims and the team. Get some brass out there from their board of directors and go see, go see Tata, Tatis rather, at opening day, Giants Padres.
Pete, would you like to make that happen?
That would be awesome. We can get some of our other generals there. We've got some cyber generals. We've got General Spider Marks. Lots of people. San Diego's awesome. I'm headed there next week. So we'll get this set up. And the Padres can't choke like they did last year, hopefully.
Yeah, they choked.
I'll do as I'm told. They did. Go on, Lisa.
I want to see Tom Keen's Wikipedia searches. I think that it would be fascinating, as different people speak. Which game coming up?
Can you imagine?
March 31st, 2022.
Look, I was sitting there on Fifth Avenue yesterday talking to this guy from Australia, can't remember, and I had my Padres hat on.
Was he from Perth?
He's from Perth, yeah, he's from the other side of Australia. But the issue here, folks, is come on. What Academy is doing is original. You got to see more of this, frankly, across all industries.
I think it's fantastic to catch up with Pete on Veterans Day. Peter, thank you. Send our best to the team. Peter Cheer of Academy Securities. I've seen that Padres hat and the Padres T-shirt.
Yeah.
In a restaurant.
Yeah.
South of 58th, too.
Really?
Yes.
And they did choke.
So a few drinks were consumed. By one of us anyway.
But I've never been to Brooklyn.
Just shouting across an Italian restaurant. New York just looks beautiful. Good morning to you all this morning.
Looks beautiful on radio.
Up 16 on the S&P, advancing a third of 1%. This is Bloomberg.
Thanks, John. With the First Word News, I'm Rishika Gupta. President Biden admits that inflation's a problem, but he insists he has part of the cure. The president says his soon-to-be signed infrastructure bill is a portion of the plan to overcome the extended effects of the coronavirus pandemic. Yesterday's inflation report showed that prices are rising at the fastest pace in more than 30 years. It's a rare moment of cooperation between superpowers locked in a geopolitical rivalry. In a surprise announcement, China and the U.S. pledged to work together to slow global warming. They agreed to boost their efforts to cut emissions, in part by tackling methane and illegal deforestation. The deal injects new momentum into the last days of global climate negotiations in Glasgow. And a federal judge has denied Donald Trump's request that his presidential diaries, call logs, and other records be given to a congressional panel investigating the Capitol riot. The former president wanted the judge to delay an order she issued Tuesday releasing those documents. The National Archives will release the records Friday unless a court orders it not to. And Belarus is ramping up the pressure over all those migrants from the Middle East seeking to cross into European Union territory. President Alexander Lukashenko says if Poland closes the door to migrants, Belarus will shut down a pipeline carrying Russian natural gas to the EU. About 20% of Russian gas flows to the EU crossed Belarus this year. And SpaceX has launched its third crew of astronauts to the International Space Station. The Falcon 9 rocket and its crew of 4 lifted off late Wednesday from the Kennedy Space Center. It's scheduled to dock with the space station later today. The astronauts will then begin a 6-month research mission. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic, and there are a handful of things going on. I think all over the world, there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We're experiencing cost pressure in things like airports and the supply chain. A lot of our contracts are longer term, so they haven't manifested entirely yet, but we can certainly see that coming in our business.
There's more to come. That was Scott Kirby there, the CEO of United Airlines. From New York City this morning, Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market open for business up 16 on the S&P, advancing 1/3% this Thursday morning. Into the bond market, close for Veterans Day stateside in Europe and Germany. Bunds yields basically unchanged to up almost a basis point, -24. This from Sarah House of Wells Fargo. Please. Tom, we're going to see the inflation picture get worse before it gets better.
But that,
I
haven't framed a 7% statistic. Are we really going to get there?
I'm not talking about it. I'm just saying apparently for the likes of Wells Fargo 6.2, we are not done.
Well, we are not done. What we've got here on the day of the bond market close is equities up, green on the screen. John, help me here. I'm seeing on a percentage change basis. What am I going to call it? A NASDAQ bounce?
A NASDAQ bounce to 98, Tom, up 0.6%. I think the bond market being closed is helping out there, TK, after the moves we saw of yesterday.
Yeah, well, we saw the moves yesterday, and we also saw the moves by one Elon Musk. David Wilson, of course, looking, as he always does, is not just Tesla, but how about a compare and contrast? And that would be maybe Amazon and Tesla. Why those two stocks?
Well, because you're talking about two companies that make up almost half of the S&P 500 Consumer Discretionary Index by weight. And, of course, that index is such a grab bag with retailers and automakers and home builders, casinos, a bunch of other industries. And what's interesting, though, is just how much volatility there's been in the relationship between these two companies. And I saw this Twitter post from a gentleman named Dan Gorghuber. Never heard of him, never heard of his firm, Van Ahn & Company. But the chart is really compelling. 2.5 years ago, you had Amazon at a record relative to Tesla, and then it plunged 94% in terms of the ratio between the two stocks.
Because Tesla did so well.
Yeah, absolutely. Right. And it's bounced back a bit this week with Tesla being down on Elon Musk share sales and Amazon up a bit. But it's clear that's just a blip in terms of the relationship over time between these two companies that dominate their category.
They're really not the same. I mean, in terms of the generation down the income statement of whatever margin you want to look at, they're apples and oranges.
I mean, they're very different businesses, no question. But, they do have a technology component to them, at least. Amazon perhaps more explicitly with the Amazon Web Services business, But, Tesla, I mean, you could just do a software update and, straighten out the cars. I mean, there's definitely that piece of the puzzle there.
Dave, there's also the piece of the puzzle that gets relayed to us on Twitter, and Elon Musk's tweets definitely causing action. Also, his brother selling shares before he did, and basically indicating a question about regulatory oversight. I'm not saying that they did anything wrong per se. Why isn't there more discussion about what the SEC thinks about some of these Twitter discussions and polls?
Well, I mean, there's no doubt that the regulators have paid attention over time, but it's not the same thing, asking in a Twitter poll, should I sell my stock, as opposed to tweeting, as Musk once did, Elon, funding secured for a $420 share buyout. So it's very different in terms of the nature of the tweets themselves. And that's the thing. I mean, the SEC wants companies and the people who run them to be able to communicate with investors in whatever way they choose. It's just a question of what they're communicating, and that's when the regulators step in when they decide, not so good.
But it also raises a question, Dave, about the depth of trading around each of these companies. The idea that Amazon is a behemoth, it's in every portfolio. So is Tesla now. However, there seems to be a more devoted share of traders more actively trading and treating it more like a penny stock some days than a behemoth. Can you give some color to what's around that?
Well, I mean, there's no doubt that Tesla can be a relatively volatile stock from day to day. I mean, we've seen that this week off everything that Elon Musk has been up to. And as you mentioned, the disclosure with his brother selling shares, Kimball being on the board. So you're going to have that. And it is interesting, like you say, that, this company with a $1 trillion plus market value in terms of how its shares behave, you're suggesting a much smaller company. We should note, though, I mean, Tesla doing relatively well this year by comparison with Amazon, no question. I mean, there are other stocks, Alphabet, that have done better among big tech. Nonetheless, Tesla holding its own, Amazon struggling a bit.
David Wilson, down the alley of Bloomberg equity coverage with Scarlett Fu, Phil Serafino, James Hertling, led by one David Wilson. You and I remember the day and the evening when Martha Stewart had to play by the rule book of Wall Street. Does Elon Musk have the same rule book as Ms. Stewart?
Oh, he does, but, the question is not, insider information in that sense.
Fair.
I mean, that's what Martha Stewart got in trouble for.
Is he playing by the rule book of Wall Street based on what you've been doing this for like 74 years, right?
Well, I mean, it's hard to say what he's doing, is kind of outside the bounds. I mean, he's making the disclosures he has to. Now, you can talk about whether those disclosures are sufficient, whether the timing should be different, the nature of the disclosures themselves. But, to this point, it's just he's got a whole lot of money. He has to come up with some cash to pay taxes. So he's selling stock. I mean, that's a perfectly reasonable sort of approach.
David, thank you so much. David Wilson, greatly appreciate there on Amazon and Tesla. John?
The ultimate troll, Tom Keene. The ultimate troll. Those tweets out on Twitter over the weekend. Tom, just say what you think. It is the ultimate troll on Twitter.
Hold on. Oh, it's.
You can't say what you think?
I can't. They're like.
You'll do it anyway.
They're over here. I can't say what I think.
Your thoughts are over there. Okay. Is that compliance over there, Tom?
Compliant? Yes, it's compliance.
We can only go through the timeline, right? The ultimate fact is that a lot of the paperwork, the filing was done in the middle of September, Lisa, to execute some of the trades that we've seen executed so far this week. And the Twitter poll over the weekend, is that significant for what's about to come next? I've got no idea.
Well, either way, it's brilliant messaging. I mean, he is brilliant in his trolling. I will say that, and gaining his followers and energizing them as sort of the countercultural person who doesn't care about the status quo and wants to innovate and wants to sort of be on the edge of what's okay at all times.
A fantastic company, $1 trillion penny stock. Who'd think we'd ever talk about that?
Well, you mentioned the debt the other day, John.
It proved everyone wrong, Tom, on both the equity side and on the credit side. Yeah. I just think it's remarkable that we talk about a $1 trillion name as if it's a penny stock.
Correct.
Lisa.
And honestly, this raises a question about the legitimacy and the depth of trading behind that, right? I mean, if you end up with those kinds of moves with a company that actually represents a massive part of the index at this point, What are we talking about in terms of the potential risk there on the downside?
Tesla this morning up 2.5%. Coming up very shortly on this equity market, more broadly away from Tesla. Mandy Zhu of Credit Suisse, looking forward to that conversation. Can we repeat the act through the next several quarters?
Yeah, really.
Corporate America is handling higher prices really, really well, tremendously well. Your equity market is still very close to all-time highs. Futures this morning up 16, advancing about 1/3 of 1%. Yields are higher in Germany by about a basis point. The US bond market is closed for Veterans Day. TK has questions as to why the equity market is not closed also. Tom Keene, Lisa Bravis and Jonathan Ferro, heard on radio, seen on TV. This is Bloomberg Surveillance.
Хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. То есть второй будет проще.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Look,
liquidity is coming into the market still, and it's making its way around to a wide variety of asset classes.
There is a good alternative right now, and that alternative is still equities.
Investors are really tired of throwing good money after bad money.
This idea that we're going to continue to compound earnings at the rate that we have is just, fantastical.
Don't get used to the last 3 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us this Veterans Day on radio, on television. Bond market closed, equity market open, and lots going on, particularly off the inflation call. John Farrow, 6.2%. Could it go higher?
It's a game changer, and maybe it could, Tom. There are others out there, including Wells Fargo, that think maybe we haven't seen the worst of it. How much patience is there for the chairman of the Federal Reserve, Jay Powell? Will he be the chairman of the Federal Reserve through next year? Can he look through this, Tom, and wait for the recovery of employment and hope the participation rate gets somewhere back close to where we were before this pandemic?
Disrespectful to the veterans to make that big announcement today, but John, slow news cycle this evening, maybe after 5 p.m.
You think we might hear soon, Tom? I think for a lot of people, this decision to wait is starting to look a little bit clumsy now, Tom, with the incoming data and the lack of clarity we've got on what the Fed looks like next year.
There was a speech. Remember, we saw the congresswoman from Richmond folks come out and say to Joe Biden, you're no FDR the other day. FDR in the famed Commonwealth speech of the early 1930s, just do something. Lisa Abramowitz, that is the primal scream this morning. Just do something.
Just do something when it comes to either building bridges and roads, but also with respect to inflation. And I do wonder the messaging from the White House, how much there is an attempt to cast blame on the Federal Reserve for some of these issues versus trying to figure out how they can affect the supply chain disruptions. I mean, how do they message this going into 2022, Tom?
What you don't know, folks, on radio and TV is John and I can go back and forth in my ear, and John's whispering to me now in my left ear. Ask her about the auctions. What was the messaging, Lisa, of the failed 30-year bond auction yesterday?
That we don't have an accurate understanding of why the long-term bonds are priced the way that they are. Right. That the market has not understood the dynamics there, and there's a lot of disagreement. And that, to me, is a pretty remarkable takeaway, given that this is considered the risk-free asset. I mean, volatility, implied volatility in bonds is the highest it's been in more than a year since the height of the pandemic, Tom.
I so set her up for that. Coming up, folks, for Global Wall Street on this Veterans Day, the interview of the morning. No, not Lee Cooperman and Dan Alpert. We'll do them later. Mandy Zhu with us here in a moment. John, I'm looking at where we are and what the markets are telling us. What are they telling us off 6.2% inflation?
We got spooked yesterday by two things, that inflation print and that bond auction, and the whole curve just headed north. The whole curve just headed north. I'm more interested in the front end of the curve right now, Tom. We breached 50 basis points in the last couple of weeks. We backed away after the Bank of England. We backed away after the Federal Reserve. Do we start to test the Fed going into Q1? And I mentioned yesterday, Tom, that Q1 you could see inflation in and around 5, unemployment still dropping lower because the economy and demand in the economy is still really, really good. That's going to be a difficult one for the Fed to sit there and say, we're going to wait. We're going to wait. We need to wait for the participation rate to recover.
Yeah, it's going to be interesting. John, let's do a data check. I'll do bonds. They're closed. John?
Thank you, Tom. I'll do European bonds. They're open. Yields are unchanged, up to about a basis point on German 10-year bonds, negative 24 basis points on a German 10-year bond. In the equity market, just a lift, a bounce back from the biggest one-day loss going back to early October on the S&P 500. On the Nasdaq, we were down about 1.5% yesterday. Nasdaq 100 futures today up 0.7%. On the S&P, Tom, up about 0.4%.
The heritage of Credit Suisse and derivatives is immense. It's dominant constant in any number of other people, including, I believe, Nassim Taleb ages ago. Derivatives and the mathiness of it has always been front and center at Credit Suisse. Holding court is their chief equity derivative strategist, the statistician and economist, Mandy Zhu, joins us this morning. Mandy, thrilled to have you with us. Can you explain the vol that you see in the cross moment skew to mere mortals? Explain the oddities of the third cross moment skew. We're not doing kurtosis. We're kurtosis free today. But your world of skew, explain how skewed skew is to mere mortals.
So thanks for that introduction, Tom. I can say definitely skew is a skew right now. But when you talk about all the macro risks, you guys led off with all the macro risks that's facing markets, inflation, the Fed, et cetera. I would say, what's currently priced into the equity market is actually fairly bullish. So one of the more notable things that we've seen in the equity market right now is that on market rally, volatility is actually going up. Now, that's very unusual because typically implied volatility decline on market rallies. And on the surface, you might think that's, more of a cautious signal that people are, buying puts or, pricing in more downside risk. But actually, over the past week on the market rally, implied vols are going higher on the back of demand for upside calls. And this is, I would say, particularly pronounced in small caps. So if you look at the Russell index, for example, Russell had a very large breakout move last week, up 6%. Russell skew actually flattened to not just a one-year low, but actually toward a 10-year low, right? And this was primarily driven by demand for those upside calls and call volumes being very, very elevated in Russell as well.
Mandy, could you describe the character of that upside position, where it's coming from? Is it primarily retail? Is it short-dated call options? What does it look like?
Yeah, sure. So at the index level, I don't think it's primarily retail. I mean, at the single stock level. So, when we talk about skew flattening, this is a dynamic that we're seeing not just, for the Russell index, but actually at the single stock level, S&P, top 50, top 100 stocks. We've also seen a very pronounced flattening in the skew. And again, primarily driven by the call side. And at the single stock level, we do think mostly this is coming from retail because in terms of the institutional flow that we see, it's actually the opposite. A lot of institutional investors, asset managers, pensions, hedge funds are actually coming in to sell calls to overwrite their positions. So taking advantage of that bid to the upside, that is, I believe, primarily driven by retail.
Mandy, taking a step back, throughout the year, people have been talking about options being the tail that wags the dog. The idea that on a single stock name, you've seen the options market really overwhelm the fundamentals and dictate some of the moves. Are we seeing that on a broader basis more than we have typically in the past?
We have definitely seen more pronounced, single stock moves. I don't, necessarily attribute that to the option positioning. So I would say, recently it's really been driven by earnings. So what we have seen over the past month is actually one of the biggest increase in single stock dispersion during earnings season in 5 quarters. When I say single stock dispersion, I mean, large single stock moves relative to the index. And this, this quarter was not just the largest in 5 quarters, the third largest going back 15 quarters. Another way of thinking of that is that a correlation, realized correlation in the S&P, has fallen significantly as we get these idiosyncratic moves on earnings. So correlation S&P is currently at a 1-year low on both an implied and realized basis. And again, the moves are, I would say, pretty broad-based. It's not really driven by one particular sector. So correlation is currently at a 1-year low for 7 of the 10 S&P sectors as well.
Mandy, on a broad basis, looking at cash derivatives versus the huge nominal gross up of what all that paper's really worth, are we at a point of derivative speculation now, or is it rather a contained normal market?
That's always kind of the question, right? I think certainly at the index level, I do not think we're in a situation where the derivatives market is overwhelming. Certainly not as a market like S&P as deep and liquid as the S&P. Certainly on single names, particular single names, you might make that case where option activity has been very concentrated. But at the index level, we do not think so.
Mandy, always great to hear from you. I've missed you. It's been too long. Mandy Zhu there of Credit Suisse on this equity market. Thank you very much. Up a third of 1% on the S&P, Tom. Just a little bit of a bounce back after yesterday's inflation-inspired jitters throughout this market worldwide.
That's interesting to see. And on the derivatives thing, John, you go back to the crises, 87, 98. It's always about leverage. It's always about something that, we're working at this as hard as we can, and you don't see it coming. And so many people look to Mandy's derivatives market as the place where there are ghosts in that. And then they seem to do pretty well.
Right now,
clear markets.
Tom, they're not scary ghosts, are they?
No.
In the option markets, at least, as Mandy pointed out, a lot of demand out there to the upside.
Well, she called it an option craze. I think that's important language.
Lisa, been bullish this year. Many people have been, and for a lot of people, that's still the trend. What I thought stood out in the last couple of weeks, and you and I talked about it a fair bit, is just how muted people are starting to see the gains through next year, the year beyond. I'm thinking Goldman, I'm thinking UBS too, through to 2023.
And we heard about this, though, in previous years, that we've already brought forward all the gains. You're only going to see single-digit returns for the S&P going forward. And others say, actually, this time isn't different, and we're going to see similar types of outsized gains. I do think it's interesting just to speak with Mandy Zhu about how there's so much dispersion on the single name stock response to earnings. This, to me, actually is a positive sign. The idea that there is discernment among the different corporations, that people are trying to understand the fundamentals, and sort of speaks against this sort of widespread casino where everything's a bubble kind of discussion that we've had, John.
2019 up by 29%, 2020 up by 16%, 2021 up by 25%. The last time we had a down year was 2018, and you remember why towards the back end of the year when the Fed had to turn a little bit more hawkish, increasingly so, and Chairman Powell, Lisa, just did not back away. And that was before the massive Chair Powell pivot that came the year after.
Is the lesson going to be to hold tight for longer than some people perhaps would like amid some of these inflation rates?
Will he keep looking through it? Chairman Powell. What a situation for this Federal Reserve. And will he be the chairman next year? We need to sort that out too. Later this hour, we'll talk about this equity market with one of the best, Leon Cooperman, the chairman and CEO of Amiga Family Office. Looking forward to that. Equity futures up 17, advancing about 1/3 of 1%. Heard on radio, seen on TV. This is Bloomberg.
Thanks, John. With the First Word News, I'm Rishika Gupta. President Xi Jinping has delivered the first doctrine on Communist Party history by a Chinese leader in 40 years. That gives him the mandate to potentially rule for life. Only Mao Zedong and Deng Xiaoping have authored a so-called historical resolution, and both used them to dominate party politics until they died. Tesla CEO Elon Musk has sold $5 billion of shares in the electric car maker. That was shortly after holding a poll on Twitter on whether he should sell 10% of his giant stake in the company. The world's richest person has sold more than 4.5 million shares this week. Those were his first sales since 2016. In South Africa, the last president of the apartheid regime has died. F.W. de Klerk took power in 1989. He removed a ban on the pro-democracy African National Congress, released Nelson Mandela from jail, and managed South Africa's first all-race elections in 1994. He and Mandela were awarded the Nobel Peace Prize. F.W. de Klerk was 85. And shares of Disney are lower today. The world's largest entertainment company reported a smaller than expected increase in subscribers to its namesake streaming service. That was only part of a broadly disappointing quarterly report. Disney's sales and profit both missed on estimates. And shares of Beyond Meat fell as much as 20% in pre-market trading. The maker of plant-based meats released a disappointing sales projection for the fourth quarter. That sparked concern that the company's growth of recent years is tapering off. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time?
What did you say about me? What did that particular gentleman say about? Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I was just finishing what you were saying, Tom.
Thank
November
you.
3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We should anticipate seeing these elevated levels of inflation, and we should anticipate seeing them for the next couple of months. What happens next year is really very contingent upon the demand side of the equation, and I don't think we talk enough about this. So we expect inflation to be elevated. That's different than transitory, but it will moderate to around 3 to 3.5%.
Right now, it's broader and stickier. That was Kristen Bitterly, the Regional Head of Investments for North America at Citi Private Bank. From New York City this morning, good morning. Tom Keene, Lisa Brabitz and Jonathan Ferro. Your equity market up 16 on the S&P, up 1/3%. In the bond market, we are closed stateside. We are open in Europe. In the bond market in Germany, yields are up about a basis point to negative 24 basis points on a German 10-year. In the FX market, get used to 114 on euro dollar maybe. Euro dollar 114.61, negative there, a little more than 1/10%. And fresh from Washington, Anne-Marie pointing this one out from Greg Valliere of AGF, quote, our odds are now at about 60% of the entire package stalls, perhaps temporarily, perhaps permanently. There's a 40% chance that something scaled back could still pass. So 40% chance that something scaled back could still pass. Just the opinion there, Tom, of Greg Valliere.
Well, he writes it on it every day. Really must read with AGF of Toronto. Right now, and this is important, when we invented Bloomberg surveillance, this is what it's about, to go from Managua at Credit Suisse on equity derivatives over to the excellence of Ira Jersey on bonds in these strange times is really what it's all about. Mr. Jersey with Bloomberg does all of our U.S. interest rate review. These notes from you, Ira, are just must read. What is the path to a faster taper?
Yeah, so I think if you get a couple more prints like this 0.9 or 1% per month, the Fed is going to get a little bit nervous about the path of inflation, and that's that's when the Fed might actually say, hey, we have to prepare maybe for an earlier hike than we had initially anticipated, and that would potentially have them reduce their asset purchases a bit faster.
Has the reaction function, or I should almost say the vector, to higher yields changed with this inflation announcement? Do we risk a jump condition?
Yeah, the market doesn't think so. In fact, if you think about what's gone on in the long end of the curve, so 30-year bonds, 10-year yields. Yeah, we had pretty weak auctions this week. Not a ton of demand, but it's not like we've seen yields shoot higher, which is something that you might have expected with the CPI report that we got yesterday. What we've seen though is the front end of the curve. So 2-year notes, 5-year notes. Those have really started to back up and really pricing for the Federal Reserve to be a bit more aggressive than the market had been anticipating just a couple of weeks ago.
I want to sit on the idea that you were talking about, that perhaps the Fed will curtail their bond purchases faster than they have previously laid out. What is the connection between their bond purchases and inflation right now?
Yeah, that's an excellent question because, some people think that the Federal Reserve, by doing all its bond purchases, is just pumping in money. It's just printing money and into the market, and that's feeding inflation. That's not as obvious because almost every single dollar that they're purchasing just winds up back at the Fed in what's called the reverse repurchase agreement facility. So around 9 out of every $10 that they're creating is just finding its way kind of recycled. So the market has so much cash that it doesn't know what to do with all that money. So instead of people going out and spending it, or banks lending that money to other people, which is the way that you would get inflation, demand side inflation, driving things higher, you just don't see that activity. So at this point, and we've been making this point for almost most of the year, is that the bond purchases aren't really doing anything to help the economy anymore. They did at one point, right? So in 2020, they were almost necessary, but for the last year or so, they just have not been doing anything because the economy does not need the amount of money that they're creating, and that's what all of these dynamics in the cash market are just showing you.
On the flip side, Ira, are they hurting the economy? And that, I think, is one of the increasing questions, especially when it comes to housing, when you see the rent increases that we've seen.
Well, the question is, why are rents going up, right? Rents are the one area where you still don't have a ton of supply, right? You still don't have, home builders aren't going out and making multifamily homes in droves like they were a few years ago. So part of the issue, I think is supply-demand imbalance in the housing sector. That's not being driven one way or the other, I don't think, by the Fed's activities. So, the Fed keeping interest rates as low as they are, yeah, maybe that is feeding into low mortgage rates, and that's having some effect on house prices. But even those have started to moderate a little bit. You don't see, while owner's equivalent rent, the CPI component keeps on going up. If you look at some of the other indicators of house prices nationally, those have started to slow down just a little bit. Now, still growing at a reasonable pace, but not as quickly as they had been in late 2020 and early 2021. So it's not obvious to me that monetary policy is really the answer here, because there still is a significant amount of inflation that's stemming from these supply problems, and whether it's supply of energy or supply of goods coming into ports, those are all where a bulk of the inflation still is.
Ira, good to catch up, sir. As always, Ira Jersey there of Bloomberg Intelligence. It's worth framing how easy monetary policy actually is right now. I thought Cameron Kreis of Bloomberg did a wonderful job of that yesterday with his column. Tom, here it is. The top nominal Fed funds target rate is now anchored at 0.25%. He goes on to say it now offers up a real yield of roughly -6 percentage points. That's nearly 20 basis points lower than at the peak policy era of the 1970s. 1970s comes up a lot. No one's sitting here and saying this is the 1970s. But he goes on to say, Tom, it seems that we are in for a laboratory experiment to see if repeating the policy choices of the 1970s produces a similar economic outcome. Provocative, but worth asking that question, I think, Tom, at this point.
Yeah, but the laboratory, it's a little bit laboratory, Adidas,
all of the above, TK. Move on.
The laboratory experiment is in place right now. We need to remind ourselves none of this is in the textbooks.
This is an experiment, Tom, based on the experience of the previous cycle, conditioned by the previous cycle to wait. How different is this part of this particular cycle?
But the attributes of the laboratory this time around are different, led by technology.
Monetary policy, Lisa, is super easy.
It's super easy, and the collateral effects are unclear. I do wonder the idea that some of these policies propping up asset prices. I think that that is fair to say that at least some of the involvement has propped up asset prices. How much this is actually keeping some people out of the labor market, right? People retiring early because their retirement funds have ballooned. I mean, all of these small factors, how much has that factored into the larger picture in ways that's very hard to quantify, John?
There is going to be so much resistance, tremendous resistance at the Federal Reserve to change course.
Yes.
Tremendous. I think so many people have become so married to their position on inflation into next year, Lisa.
I agree. I do wonder, though, if the conversation will start to change, that having a steady hand does not mean staying the course when you start seeing CPI prints with a 6 handle or, say, a 7 handle.
Looking forward to the forecast in the middle of December. It's going to be very interesting to see what they look like. We know there are some hawks on that Federal Reserve relative to the super doves on that Federal Reserve, and they're going to start making a bit more noise, I would have thought. Futures up 16, advancing a third of 1% from New York City on radio, on TV. For our audience worldwide, this is Bloomberg Surveillance.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
live from New York City on radio and on TV. This is Bloomberg Surveillance with Tom Key and Lisa Abramowitz and Jonathan Ferro. Your equity market looks a little something like this. Futures positive 16 on the S&P, advancing about a third of 1%. No economic data for you today. No notable economic data today anyway. Outside of the bond market in America, which is closed for Veterans Day, you look to Europe, where the bond market yields are a little bit higher by a basis point to negative 24. And the stage is very much set for December. On the 15th with the Federal Reserve, on the 16th with the ECB, and this very simple but effective take from Bank of America. The heat seen in rents and across services could make the Fed begin to sweat as they wait out the return in the labor supply. Clearly the risks are for timing of rate hikes to be pulled forward. And yesterday, Tom, they were.
I got into the 2022 meetings as well, even out to, I believe it's May 4. I can't remember right now, John, but each and every meeting is going to be interesting. Of course, we await a decision on who will be the next or the continuing chairman of the Federal Reserve System. Right now, and this is a joy, Dan Alpert and I have not read Piketty, all 816 pages of it, but Mr. Alpert joins here with his definitive book on the crisis on the age of oversupply, and he is fired up a la Piketty and if inflation in the 21st century. And let me lead with your emotion off this report. You say, lose the bah humbug. We should be grateful for this inflation.
Well, to a certain extent, we have to be because of the enormous amount of government transfers that really bailed out not just households, but also the corporate sector and certainly businesses that employ people. Without that, we would be in a sort of Dickensian disaster at this point. And that is where we are right now with inflation running hot is far preferable to that. I think that's easy to understand. Having said that, I think there's a great deal of pain, both pain to households and political pain being felt in Washington over this inflation. But the answer is this is still very much a transitory phenomenon. The definition of transitory, however, is still a problem.
But with your love of history, and you mentioned Charles Dickens' death, 1870, 5 years before Dickens died, Jevons made us dynamic. Before that, it was static. And after Jevons and Walrus, it was dynamic. Do you have a confidence that our dynamic system can make it transitory in some form and lessen this inflation?
If anything, the system's even more dynamic today. What you're seeing right now are actual responses to an event that was, quite frankly, non-economic, but had massive economic consequences, a global pandemic. And so what we're experiencing today are the after effects of that in the form of massive supply disruptions, which began during the pandemic, let's face it, with shutdowns in Asia and all sorts of things that have metastasized across transportation, distribution, all of the logistic problems that we have. We have an enormous demand surge fueled by all those government transfers and the fact that consumers had nothing to spend their money on for a very long period of time. That's going to continue until that money is depleted, and it will be in fairly short order, probably shorter order than people anticipate.
Lisa, I shook there for a moment. Mr. Alpert said metastasized, and I thought he was going meta on us.
Yeah, we're not going to be talking, hopefully, about the metaverse just yet, although perhaps we'll get there. Dan, I wonder, though, at this point, when the inflationary impulse becomes problematic for growth, the idea that people stop buying as much when it costs as high as it does.
Yeah, that is definitely an issue. We're actually experiencing a little bit of that right now in some sectors. You do see some reacceleration of the economy now in November. Certainly, the economy slowed down during the summer. There's no question that there are going to be buying decisions put on hold, specifically in in durables that have gone up in price. Obviously, cars, people are not, to the extent they can get hold of them, they're not going to be able, many of them are going to have to put off decisions because they're very expensive. But we have other things going on at the same time that are also problematic, and that is we're still down. There's a reason for that. A lot of those jobs that remain unfilled, most of them actually, the vast majority, are low-wage, low-hour jobs. Those jobs are held by workers who benefited enormously from all of the cash that flowed through supplemented uninsurance benefits, and that is burning off now. People actually had weeks of reserves at the end of September 6th when the unemployment benefits stopped. And now you're seeing, as these you saw revisions to the employment situation print last week, and you're seeing numbers rising. People are going back to work. That's going to help. The food side of this is hugely discouraging to people. You know, you talk about slowdowns and other things. People have to eat. And the problem is, from a political standpoint, when people start seeing their food bills go up, specifically meat, which they're kind of gotten used to buying steaks and stuff, that is really harmful across the board. But food is a reflection of fuel and transportation, and those costs have skyrocketed. But fuel itself is a real issue here.
But before we get into the oil discussion, Dan, how concerned are you that wages are not keeping pace with the rise in the price of meat?
Hugely. Obviously, the to the extent that wages are not keeping pace, it creates enormous political problems across the board. That is something that is going to correct itself when prices actually correct, and that's going to happen during the course of the next couple of quarters. Look, at the end of the day, I do believe this is all wrapped up certainly by the end of the second quarter of next year. And it could actually happen sooner. One of the things that I was talking about in a conference yesterday is the prospect of a major disinflationary down spike when we actually catch up with all of the backlogs in supply chain. That is really a significant issue. We've ramped up production in Asia to huge levels. Factories are running 2 and 3 shifts. Production is at a huge high. That's going to continue. You have China. Look at China. China is not going to be building housing anymore because of the Evergrande situation and related situations. They're going to return right back to the export sector. So we're really going to be overwhelmed with supply in a few quarters, and I think that's going to create just the opposite of the effect that we're seeing today.
Dan, you and your team have done path-breaking work with Cornell Law on parsing the American labor economy. The media take is, let's talk about wage growth, let's talk about inflation-adjusted wage growth. You take it further and look at the cohorts of America in real wage growth. Are we all going to get crushed?
Well, look, the bottom line is, going into the pandemic, we had deteriorated the quality of American jobs, meaning we were very dependent on low-wage, low-hour positions. The pandemic obviously eliminated an enormous number of those jobs, and they're slowly creeping back. The real question is, post-pandemic, are we going to be right back to where we were? We've seen substantial percentage increases in wages paid to previously low-wage, low-hour job holders. But nevertheless, if you see a dollar increase to a $16 an hour wage, what is that, across the board on an annual basis? It's just not a lot of money. So from an aggregate demand standpoint, while those percentages may seem very, very attractive, it really doesn't move the needle in a big way. So, look, is it to the good? Of course it is. And to the extent that it's sticky, and generally upward movement in wages and incomes are sticky, that's a good thing. Let's just hope it continues.
Dan, just real quick here, how concerned or how aware are you of some of the changes going on in China, the factory to the world, to try to bring common prosperity, higher wages for people who previously were known for accepting low wages and causing a disinflationary impulse throughout the world?
Well, the problem, of course, is that China is run for employment first, right? They have to create roughly 10 to 12 million jobs a year in order to absorb the population that's coming of working age. And unless they do that, they're going to have, far worse than prosperity. They're going to have social disharmony. And so they have to produce those jobs. They've been very reliant on the investment sector to do that, specifically residential construction and infrastructure. You eliminate residential construction from that, what are they going to do to create those jobs? The answer is they're going to put more pressure on their export sector. That's really the only place they can go. And so the idea that somehow this is going to roll over into a more inflationary environment, or China's going to export less disinflation, I guess is the way to say it, I think is the wrong argument.
Hey, Dan, that argument got some fuel this week. PPI 26 years highs. Dan is going to catch up, sir. Dan Alpert of Westwood Capital. A man who agrees with Dan Alpert to some degree. Krishna Mamani of Lafayette College is going to join us in about 20 minutes' time on Bloomberg TV. TK, he thinks we're going back to the twos. 2% GDP, 2% inflation. That's the call from Krishna for much of this year.
Well, there's some of these, and it's the one of it, of course, from Dr. Mamani. But, I look, John, at the set of calls out there combining price change and growth. And it's any, there's any call you want.
Would you like to recap the forecast from the Fed for next year, Tom? Core PCE 2.3%, real GDP 3.8. They're the calls. They're the forecast currently.
Yeah. Are they still doing dots?
They will still do dots. You will get your update in December 15th.
I didn't know that.
Those dots, you'd have to imagine those dots.
Are you going to be here or are you going to be gone by then?
I will be there, Tom. I'll be there for the special. I'll be there the morning for the ECB on the Thursday, and then I'll be out of here.
Lagarde gave you permission to...
Year over after President Lagarde says Happy Christmas and departs, Tom.
That's good. Very European of you.
Just staying true to my roots, taking a break. Yeah. Futures up 16 on the S&P. I understand you're taking one too. Up a third of 1% on the S&P 500. I've been counting, Tom.
Really?
You've been taking more. In the bond market, closed for Veterans Day in the United States. Yields unchanged, negative 25 on a German 10-year. Don't you count Tom's out?
No, I don't.
You don't?
No,
you
I
don't.
No.
You don't count the days? It gives you a hard time when you take time off.
Do you count my days?
I don't know. No, you're very good about taking time off and very accommodative of me taking time off.
I'm not.
I think
Tom is not.
All right. Glad to hear this.
Take the rest of the year off, Tom.
It's good.
Good. All right. Futures up 16. It's good they still keep us separated, even though they don't need to anymore.
I know.
The social distancing is working out.
We're very distant.
Is this you that's making the ultimate decision about us coming back together again?
Me?
Do you have the final word?
No, I
Does Lisa have the final word?
It's not a word.
And
it's
we're
just
maintaining this social distance because of one person?
Yes, we are.
Okay. Program note, Lisa and I are together. So, do the math on this. Who might be making this decision? From New York, this is Bloomberg.
Thanks, John. With the First Word News, I'm Ritika Gupta. It's a rare moment of cooperation between superpowers locked in a geopolitical rivalry. In a surprise announcement, China and the US pledged to work together to slow global warming. They agreed to boost their efforts to cut emissions, in part by tackling methane and illegal deforestation. The deal injects new momentum into the last days of global climate negotiations in Glasgow. President Biden admits that inflation's a problem, but he insists he has part of the cure. The president says his soon-to-be-signed infrastructure bill is a portion of the plan to overcome the extended effects of the coronavirus pandemic. Yesterday's inflation report showed that prices are rising at the fastest pace in more than 30 years. SpaceX has launched its third crew of astronauts to the International Space Station. The Falcon 9 rocket and its crew of 4 lifted off late Wednesday from the Kennedy Space Center. It's scheduled to dock with the space station later today. The astronauts will then begin a 6-month research mission. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
So you...
stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There hasn't been this kind of capitulation from the Fed on the inflation story. And I wouldn't expect that in December. And I wouldn't expect it in March either, because if anything, the composition of the FOMC is going to change. I don't think Biden is going to put people in there that are going to adopt a more hawkish response function to the data.
And Neil Dutta, Renaissance Macro, emailing me moments ago. Neil, thank you so much for watching. And what he says is simply he's watching stronger U.S. dollar. Lisa, we've seen that stronger dollar this morning.
Yeah, and rate hiking expectations as people bring forward the pressure on the Federal Reserve and the expectation that they will be forced to respond.
Yeah, quick data check here. Equity markets are up. Bond market closed today for Veterans Day, and the dollar with some strength. I'm going to quote Euro 114.63. I sent a note to Lee Brody, who does all of our booking with the types of Leon Cooperman, and I said, Lee Brody, get Leon Cooperman on. There's any number of reasons we can always speak with a gentleman from Goldman Sachs, and of course now chairman, chief executive officer at age 78 of Omega Family Office. But far more, it's about the never-ending debate of a wealth tax and of going after the billionaires. Mr. Cooperman has been more than vocal, harkening back to a letter of 2-3 years ago to the senator from Massachusetts. It is a 5-page, single-line doozy where Leon Cooperman takes on the liberals, the progressives, and Senator Warren. We are honored that Leon Cooperman could join us on Bloomberg Surveillance this morning. Lee Cooperman, the debate is the same, and yet it's different. What's different now versus when you wrote that letter 2-3 years ago?
Well, I think it's becoming a little bit clearer that the general populace is not in alignment with the progressives. You know, you saw that election in New Jersey, you saw the election in Virginia. And they dropped the proposal to have this tax on unrealized gains. But, you know, I'd like to take a second, with your permission. I'm not involved in politics. About 2 years ago, I gave a speech at a hedge fund conference at a time when Elizabeth Warren was running strongly in the polls. And none of my speech was directed towards politics. At the end of my speech, the moderator asked me, what do I think the market would do if Elizabeth Warren won the presidency? And I said, you know, maybe I was optimistic. I said the market would drop at least 20%. The very next day, not knowing anything about me, she tweets, Leon, I'm only looking for 2%. Give others a chance at the American dream. And I made a decision to take the high road, and basically Michelle Obama once observed that when they go low, we go high. And I wrote her a very good letter, the letter you just cited a moment ago, and she showed to me that in the best sense, you know, if I wanted to be polite, I would say, and respectful, I would say that she's a politician in the worst sense of the word. And if I wanted to be a bit more sharp-tongued, I would say that she's a nasty fool, but let me explain. You know, when I wrote the letter, basically her response was, you know, insider trader and own stock in Navient. Totally unresponsive to the intellectual content of my letter. You know, the fact that she libeled me, I won the case with the SEC. I was not fit in. You know, I'm sorry, go ahead.
No, Leon, this is really important at a moment when what you call the vilification of the rich is gaining steam, that the idea that people feel like there is a fair share to be paid and that the wealthiest individuals are not paying it. What is the backdrop leading to the increasing calls for the fair share rather than trying to close loopholes in some of the other proposals that you've put out there?
It's a good question. I think it results from income disparity, and the income disparity largely results from government policies. You know, go back to 2008. Mr. Bernanke figured out the economy was going down the toilet. He had to rescue the economy. He figured the best way to rescue the economy was to get wealth up, because wealth leads to consumption. And the best way to get wealth up was to get the stock market up. The trouble is 80% of the stocks are owned by 20% of the people. And so income disparity grew.
Right.
And the government tried to get that money back by creating an environment where there's been no return for savings.
Leon, I've got to get to the heart of the matter in 2021. And here's the bottom line. We've got a definition in this nation that 400,000 is filthy rich. It's St. Barnabas Hospital in New Jersey. If you've got a full-line doctor, surgeon, whatever, and the spouse is working as well, or even if it's a single person, they're paying $400,000 and they're deemed by liberals to be rich. With all your experience growing up dirt poor, is $400,000 in 2022 rich?
I don't think so. I don't think so. I think doctors have gotten totally screwed by the government when I look at what they have to go through to get their degree and be able to practice, and then with the controls over their income. Look, I believe in the progressive income tax structure. I believe rich people should pay more in taxes. You know, the question we have to deal with as a nation is coalesce around the question: what should the maximum tax rate be on wealthy people? Because that will define the revenue yield to the government. The government has to size themselves to that revenue yield. Okay, and all this talk about wealth taxes, it's all baloney. They said, let them close the loopholes. You mentioned that a moment ago, Lisa did. You know, 1031, the ability to roll forward indefinitely, real estate gains. You know, get rid of that. Get rid of carried interest for hedge funds. Raise the tax rate. We don't need new forms of taxation. Okay, we just deal with the loopholes.
I do want to just go into something that you were talking about, the idea of monetary policy pushing up equity pricing, and that does not reach everybody. Do you think that monetary policy, where it has been, has exacerbated the divide that has led to the discussion that you're talking about right now?
Yeah, I would say so. Look, you got to go back. You know, Bill Clinton didn't vilify wealthy people. Ronald Reagan didn't vilify wealthy people. George Bush didn't vilify wealthy people. I respect Obama as an individual, but he started this whole thing. You know, I become a letter writer. I wrote him a letter 9 years ago, and I said, you know, you're basically telling the 99% they're being screwed by the 1%. Why don't you tell the 99% with a lot of hard work and luck they could become part of the 1% instead of vilifying the wealthy? I think the world's a better place because of Bill Gates, Jeff Bezos, Bernie Marcus, Ken Langone, and people like that. You know, I don't see a reason to vilify them. Tax them. I have no problem with taxes. You know, I've taken the giving pledge of Buffett, and I've taken another giving pledge of my friend Mike Levin, the Jewish giving pledge. I'm giving away all my money. You know, so it's not a selfish motivation.
Leon, we got to leave it there. We are out of time. We'd like to continue this discussion as well. And Leon, we've got to get you into our studios here in Manhattan when you decide to leave the acreage in New Jersey. Leon Cooperman with Omega Family Office today. Lisa, let's wrap this up. And I think, I guess I've got to, take a leaf out of the Pharaoh playbook and say front and center is the watch for the next Fed chair.
The idea here of what will the Fed look like when it's dealing with some of these really hairy questions. I keep going back to this idea of having a steady hand for the Federal Reserve. Does the definition of that change as the data changes? That steady does not mean doing nothing.
It's going to keep us employed here, of course, the shock of 6.2% inflation. To me, Lisa, today, just to see the idea of thinking about 7% inflation, I really didn't think about that. There it is.
I love the idea that the bond market's closed, and that's actually helping equities rally a little bit more, at least on the NASDAQ.
Getting huge response. Equities, why are bonds closed and equities are not, vice versa?
Bonds are a more somber asset class.
Are bonds ever open when equities are closed?
I'll have to do some surveillance research.
Philosophical questions.
Very deep.
Stay with us on radio and television. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
have a little bit of a bounce back this Thursday morning from New York City for our audience worldwide. Good morning, good morning. Your equity market bouncing back 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, transitory, needs a rebrand.
What we got was incredibly strong.
Both headline and core inflations are well above expectations.
Inflation is going to be getting worse before it gets better.
Pressures, John, have gotten broader and broader, probably continue for a while.
More likely to be persistently high rather than going down.
We're now in the perfect environment for sustained inflation for at least 2 more quarters.
The next 3 to 6 months, we're going to see continued pressure.
It's very hard to argue that these conditions are going to be true a year from now. Thinking about trying to call that turn, it's extremely difficult.
The transitory versus structural question is still in play.
The key question here is whether this inflation print is going to translate into higher inflation expectations.
Is this going to change the Fed's course in terms of taper? No.
I take Chair Powell at his word right now that they're planning on waiting.
Are we going to go back to a sub 2% inflation rate as we have for the last 10 years? I think the answer is definitely no.
Joining us now to discuss is PGIM's Robert Tipp, Krishna Mamani of Lafayette College, and Winnie Caesar of Credit Sites. Winnie, you think stay the course on transitory. Winnie, why?
So I do think that we're going to see a few more quarters of pretty strong and sticky inflation. And that's clearly going to be really concerning to investors, to management teams, to politicians. But the reality is you should never underestimate corporate America's ability to adapt to new environments. We've seen that over the past 18 months with adapting to the pandemic. And now we're starting to see how corporate America is going to adapt to this new inflationary environment, be it supply chains, be it commodity prices and input costs or labor costs. We're seeing a tremendous reaction that further out is going to be pretty significant when it comes to what inflation looks like in 2023 and beyond.
Krishna, to some degree, you agree. You think we're going back to the twos on inflation by the end of next year. Krishna, after you saw that 6 handle yesterday, did you rethink anything?
Well, so, it would be imprudent to kind of stick with a very regimented view of the markets. Clearly, the 6 handle is somewhat scary for everyone, including the Fed. Having said that, I think the reality is, as Winnie was arguing, the outlook, the fiscal impulse outlook in 2022 is meaningfully different than what we are seeing today. So yes, the print was bad, but it wasn't entirely unexpected. What we have to look forward to is whether 2 things. Do the supply chain issues and the participation rate get resolved in 2022 or not? If they're not resolved, then the Fed is totally behind the curve. But I think the expectations, at least my expectation, is that it'll get resolved in some way. Maybe not as much as I may have expected, but I don't think we will see 3 or 4 inflation handles by the end of 2022.
When he says stay the course, I hear the same thing from you, Krishna. Bank of America say the following: the heat seen in rents and across services could make the Fed begin to sweat as they wait out the return in the labor supply. Clearly the risks are for the timing of rate hikes to be pulled forward. That is clearly the risk right now, Rob. Robert Tipp, do you think they will stay the course? It's not a matter of whether you think they should. Do you think they will?
Well, I think that in some respects, we're looking at the wrong question. If we're trying to figure out what we should be doing in terms of investing, actually, this is going to sound ridiculous, but the inflation question and the Fed question are not the primary questions. I mean, since the end of March, high yield returns have been positive, and even the aggregate bond market's total return in the U.S. is 1% or so from its all-time high. Even in Europe, with their low yields, it's just 2% below. So, over the last 25 years, inflation has been roughly stable in the U.S., and against that backdrop globally, interest rates have continued to come down. So I think the benefit for investors of this intense focus on inflation is, it probably is going to be high for 1, 2, 3 years. And while people are busy focused on that, the long bond has already rallied 60 basis points. right? So while the market is pulling forward aggressively, when is the Fed going to start moving? When is the ECB going to start moving, which is really a bit of a reach. While that's been going on, the back end of the curve has been rallying. So that tells you either, by fire or by ice, this long end of the bond market is going to be stabilized, either an overheating where the Fed controls inflation, the market has faith in them, is going to be positive for the back end, or we'll get some moderation, we'll get a bull steepening, and returns will be reasonably good. So I think the pricing of the bond market is very attractive, frankly, given what's going on here.
Robert, just to be clear here, what is the right question? If it's not the right question to explore inflation, to explore rates, what are you saying the right question is?
That's right. The answer is that we're still in a secular environment of declining real rates, a bond bull market. And the question is, when do you buy? And the answer is when you're at the peak momentum of economic recoveries. In 2003, in 2009, 2013 taper tantrum, March 31st of 2021 for a lot of markets, and this fourth quarter of 2021 in some of the more overheated markets. I think that's the question, because in the long run, yes, this is, every economic recovery is different, and this one is incredible. I mean, these inflation numbers are bonkers high, right? There are things going on in the global economy that we've never seen before. And it looks like they have some legs, and you're going to see this going on for a while. But the central banks are stuck on hold. They're buying bonds. They're going to wait until the middle of next year. They're going to wait until the dust settles. And by the time you get there, you'll probably see that, the rents, real estate inflation is sticky. That's the market working. People have changed their preferences. They want to own. So that'll be ongoing. But in the other areas, to Krishna's point, I mean, once commodity prices go up, that component of inflation goes to zero. If they come down, it goes negative. And other areas of the economy will be beginning to loosen up. So are we going to be below the Fed's target at the end of next year? That's a stretch. But are they going to see things going in such a way that the current pricing for hikes is too high? I think that's probably correct.
Winnie, does this resonate with you?
It does resonate with me. And I think one thing that Robert's really getting at is the shape of the Treasury curve is very important for corporate credit investors right now. And we have a lot of investors asking us, have we hit peak steepness in 2s, 10s? Is the long end kind of stuck in the mud from here on out? And then how are we thinking about the front end? Because the front end and perceived rate hikes or actual rate hikes are really what's going to push investors out of low yielding fixed income like US investment grade and kind of back into cash. And so long as the expectations for rate hikes are a little bit further out, then I think we're going to see plenty of good demand for corporate credit, despite the fact that we have these lofty inflation prints and that yields are very low. And then the long end really is quite anchored with the ECB and the Bank of Japan and just so much stimulus and accommodative monetary policy still embedded in the global financial system. It's really hard to get that uplift in yields. So I'm very concerned about kind of the shape of the curve and the Fed's ability to manage the shape of the curve in the near term.
2s, 10s, of course, peaked at the back end of Q1, in and around 160 basis points, 157 to be precise, right now at about 103. The three of you seem to be on the same page, so allow me to throw out something a little bit more provocative. This came from Mohammed Al-Erin on the Financial Times piece he put out a little bit earlier this morning. I'm going to read the conclusion to you, Krishna, and I want your reaction to it. Failure to act promptly would turn the Fed's increasingly discredited transitory characterization from one of the worst inflation calls in decades to also a big policy mistake with widespread and unnecessary damage. That's Mohammed's view. It's been building for several months through most of this year. Krishna, why do you disagree?
Well, so I think, first of all, it's good to have Robert on the panel with me because usually I'm on the left side and he's even more left of me. Having said that, I think the point Mohammed is making is that inflationary pressures will remain persistent even when the fiscal impulse goes down for whatever reason. I just disagree on that particular premise. Right now, it's quite clear that inflation for the next 2 or 3 quarters will probably be higher. The real question is, and this is what the Fed is contemplating, is how would things look like by end of 2022 when US growth would have slowed down meaningfully, fiscal impulse would have faded. From a political standpoint, the likelihood of passing any significant additional fiscal measures is going down meaningfully. Yeah. China is slowing down. So all of those pressures come to bear towards the end of 2022. Trying to make predictions as to how persistent inflation is going to remain based on what we see today, it seems to me is somewhat not misguided, but somewhat projecting what we see today forever.
Well, it's difficult. It's difficult to do. And I'm not here to say that one of you is right, the other one's wrong. I do wonder, Krishna, though, what would be the tell for you to change your mind? And I think that's an interesting test for this Federal Reserve as well. When I asked Vice Chair Rich Clarida that very question earlier this year, he said at the turn of the year, we'll get a better idea of how persistent some of these forces are. Here we are, staring into the end of the year with a 6 handle. Krishna, I wonder what the tell would be for you, sir.
So two things, as I said before. The supply constraints have to ease. And if they don't ease, then the goods inflation that we see today is probably going to persist. And the other point would be to see an increase in participation rate. If the participation rate remains as low as it is today, we are going to have a problem. Those are really the two things to monitor. What is happening today and whether it is 6% and 5% monthly print, I think to some extent is really, it's relevant, but it doesn't really tell you how things will look like 2 years out.
It's the sticker shock of it all that got everyone's attention, a 6 handle. Krishna is going to stick with us. Krishna Mamani, Robert Tibb, Willie Caesar, coming up on this program. President Biden defending his economic agenda.
According to the economic experts, this bill is going to ease inflationary pressures.
The president and his thoughts coming up next. We'll get the reaction from Anne-Marie Hordern down in D.C. This is Bloomberg.
Common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Jobs are up, wages are up, values are up, and savings are up. But we got problems too. Many people remain unsettled about the economy, and we all know why. They see higher prices. We're tracking these issues and trying to figure out how to tackle them head on.
President Biden calling inflation a top priority while promoting his Build Back Better agenda. Republican Representative Kevin Brady warning inflation is here to stay.
you're going to see higher prices for a lot longer. And right now, I think that's one of the reasons Americans are so fearful. Inflation has now become tied with COVID as their main concern, and the bulk of Americans have lost confidence in the president's competency to heal this economy.
The politics of this were always going to be obvious. Anne-Marie Jourdain joins us now. You were there yesterday, Anne-Marie, the president in defensive mode.
Yeah, certainly is. And the CPI data really overshadowed his speech, and that is what he led on. They want to make sure two things, Jonathan. They can get the messaging right on this to not overshadow the win that they have in terms of the hard infrastructure, but also pushing ahead to their second agenda. So on the messaging, he really leveled with the American people that there are problems. Everything from a gallon of gasoline to a loaf of bread is up. The issue is the president once again cited those Nobel laureates that talked about his economic agenda, including the $1.75 trillion for the human infrastructure, saying that that will bring inflation down. But the letter really says it will ease long-term inflationary issues. So what the White House is dealing with is how to have an immediate reaction to something that is hard to have an immediate reaction to. And the other problem is Bloomberg Economics says that this is just the start. Inflation, that figure is likely to go higher. And this has to do with not just energy, but food and shelter. Yeah. So it's really going to be difficult for them to message around this as they try to push through more spending.
Sarah House of Wells Fargo said the same thing. We may not have seen the worst of this. AMH in DC on the latest. Anne-Marie, thank you. Talking of the immediate reaction, it took 1 hour and 8 minutes to get the immediate reaction of Senator Joe Manchin after that inflation print. This is what he had to say. By all accounts, the threat posed by record inflation to the American people is not transitory and is instead getting worse. Americans know the inflation tax is real. DC can no longer ignore the economic pain Americans feel every day. That was Senator Manchin. Here's the reaction from Evercore. Here's the quote. The hot print raises political pressure on the Democrats and at the margin makes it more likely that Manchin may demand deeper cuts to the reconciliation package under negotiation. That's the conversation I want to have briefly right now. And Krishna Mamani, I want to have that conversation with you, sir. You've been focused on the fiscal arc of policy, much more than the monetary policy arc, I think, than most. I just wonder how you've evolved your thoughts on what we might get next.
Well, so I think the likelihood that you see significant fiscal initiatives that will have a near-term impact in 2022, 2023, the likelihood of that has gone down meaningfully. And I think both from a political standpoint, but from an economic standpoint just as much, that the need to do all the things that a very large $3 trillion plan would do, I think the need for that has gone down substantially, but again, from both political and economic standpoint. So I think the scale and size of any significant or any fiscal moves in the future has gone down because of what we have seen in the post-COVID era with respect to inflation.
When a key vote down in DC comes out almost immediately and said it's not transitory, it's getting worse, you have to take notice, don't you?
You absolutely have to take notice, but you have to kind of handicap it with the reality that politicians are very focused on kind of speaking to the economy in a way that feels like it's going to kind of get the attention drawn to them, feel like they're proactively addressing things. You know, sometimes the headlines can be a little bit scarier than the long-term realities, at least in my opinion, actually are. And I think that to, you know, kind of put the kibosh on longer-term fiscal support because you have this kind of immediate inflationary pressure might be a little bit short-termism overall, but you do have to very closely kind of look at what the spending is and what the actual drivers of economic momentum within that package are going to be. And clearly that's a hot debate right now in DC.
Making an economic assessment is one thing. Making a political assessment, Robert Tipp, is another. Trying to work out what the policy reaction will be to this down in DC, I think, is pretty difficult, almost as difficult as forecasting inflation next year, Robert. Would you agree?
Yeah, well, I want to bring this back on the fiscal side to the sequential aspect of it. So We're going to see some stimulus, and it's going to be spread out over years. It's going to be nothing compared to what we've seen the last 24 months. So we're looking at a fiscal headwind here. The only question is, how gigantic is it going to be or how big is it going to be? So they're taking their foot off the accelerator by bringing down the deficit, and we've seen that in the Treasury refunding announcement the other day. The amount they will be borrowing is coming down. So that's a headwind for the economy. I wanted to come back to the inflation and the central bank discussion, because one of the things we're seeing right now, we haven't seen since 2000, since 1990, since 1980. I mean, we've seen the Fed in general be too hawkish, and Chairman Powell talk about how we've undershot on PCE. But what we're seeing
forgive
right
me for
now,
jumping in, sir. Just forgive me for jumping in. Just hold that thought. I want to take note of something. The US bond market today is closed for Veterans Day. Here's your moment of silence on the New York Stock Exchange.
Lost its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I
would say the biggest challenge that we have, and I would say broadly across many industries, is really the health of the supply chain. And if you think about building a vehicle like this, like our R1T, there's around 2,000 parts that come in from end item parts that come from suppliers. And this is one of those rare situations where a 99.5% is not good enough.
The Rivian CEO, he's got to grapple with things everyone's got to grapple with, supply chain difficulties, with the exception that he's just getting started. They've only just started to deliver vehicles in the last couple of months, and they have an $86 billion valuation on them now. Remarkable stuff. In your equity market, we bounced back on the S&P by 16 points, up about 1/3%. On a Russell 2000, up 0.4%. A bounce back on the Nasdaq after yesterday's mess, with yields pushing hard at the long end after that soft, messy auction. Your Nasdaq 100 up 0.75%. That's the equity picture. Let's get you some morning calls quickly. First up, Morgan Stanley upgrading GoPro to equal weight. The analyst citing management's improving execution amid continuing supply headwinds. That stock is up by 3.31%, almost at 10 at $9.99 in the pre-market. Your second call from Bernstein downgrading Beyond Meat to market perform. The analyst seeing a number of lingering headwinds related to supply disruptions and demand trends. That stock's getting absolutely hammered. We've seen this a few times this earnings season. If you miss, you get punished. They are getting punished and punished bad. We're down 15% in early trading to 80 on Beyond Meat. And your final call, third and final call from Cowen, cutting its Disney price target down to 137. Following earnings after the close yesterday, the analyst now seeing a slower than anticipated recovery at its Parks division. That stock is down by 6.25%. The subs not quite in line either, 163.50 on Disney right now. Coming up, investors and their appetite for inflation protection. Is it time to lean the other way? We'll have that conversation with Robert Tibb, Krishna Mamani and Winnie Caesar. The opening bow just around the corner. Your equity market this Thursday morning is positive. Good morning to you all. The opening bow's next. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell in New York City this Thursday morning. Good morning to you all. Coming off the back of the biggest one-day fall, biggest one-day drop on the S&P since early October 4th to be precise. We bounced back this morning by about 1/3 of 1% at 14 points. On the Nasdaq, positive 3/4 of 1%. Yesterday wasn't pretty for the Nasdaq 100. Let's your opening bell, switch up the board and get to the bond market. Not in America, where we're closed for Veterans Day, but over in Europe, in the bond market, yields up about a basis point to -23. Came close to looking at zero earlier in the month. We started the month at about -10 basis points. We've backed off since then. Similar move we've seen elsewhere around the world as well, as the ECB starts to talk up maybe changing things up in December. The bond purchase program needs to change. How much flexibility carries over from the pandemic emergency purchase program? That's going to be in focus December 16th. What are 2 days we've got lined up? Middle of December, 15th, the Fed decision, 16th, the ECB call. Euro dollar -10, get used to 114 maybe, 114.70 on euro dollar. In the commodity market, we're positive 1/3 of 1% to 81.60. As we get open, 40 seconds into the session, the S&P advancing about 1/3 of 1%. Top of the pile, consumer discretionary up 0.9 of 1%. Bottom of the pile, basically what led yesterday. Utilities, staples, healthcare. Utilities are down about 1/4. Staples and healthcare basically unchanged on the session. With us for some early thoughts around the opening bell, Robert Tipp, Krishna Mamani, and Willie Caesar. Krishna, I'm always interested when people's views start to change. Maybe yours hasn't, but when I was starting to read through your notes, when I read the following, you maintain the right level of risk. It's got to be critical. Maintain the right level of risk. The front end becomes more vulnerable. The front end vulnerable. Maintain the right kind of risk. Krishna, this doesn't sound as bullish as you were maybe a month or two ago.
So the bottom line is the risks in the markets have gone up. They have gone up because of valuation reasons, and they have gone up because of lack of or persistency of inflation. So I think trying to kind of shoehorn an old view in the current reality, I think doesn't make any sense. So the point I'm trying to make is overall, the risks in the markets have gone up because inflation has stuck around for a lot longer than what all of us had expected in the beginning of the year. So, and the real question is, what is a good inflation hedge? My view would be that the real inflation hedge doesn't exist anywhere in the marketplace today, because at the end of the day, if inflation is persistent, the Fed would be forced into raising rates far faster for a lot longer, and therefore probably take us into a recessionary framework. In that environment, perversely, the only hedge that you would have for that outcome is really cash. So if I'm building a portfolio today, I'm building a portfolio with equities and cash, maybe a higher dollop of European equities, maybe a higher dollop of emerging market equities, even there reluctantly because of the likelihood of a dollar strength in that environment. But the hedge or the right portfolio construct today is really equities and cash.
Krishna, how much cash?
So I think a lot more cash than what you would have had over the last 10, 12, 15 years. So in my personal portfolio, for example, sure, I have almost 30% cash. For a more persistent investor like the endowment, where we don't have that luxury, maintaining flexibility, maintaining liquidity, maintaining an ability to redeploy capital if market opportunities deliver themselves. I think those are the things to think about right now.
Robert Tipp, your thoughts on that, the cash position. Oksana Aronoff of JP Morgan Asset Management was on this program last week, talked up a 50% cash position in the portfolio. Can you afford to carry that much cash?
I think that's exactly the kind of thing I'm arguing against. That, over the last 40 years in this disinflationary environment, real rates have been coming down. Stocks have done better than bonds. Risky bonds have done better than low-risk bonds, but bonds have outperformed cash. And the points to go into the market have been at these scary points when there's an economic recovery. What we've seen since March is the Fed, their dots have dislodged from zero. So we know that there's, the bulk of that committee has no problem if they need to raise rates to control inflation. But, do you want to be sitting there in cash, which right now has a negative 6% yield, right? You lost 90 basis points in cash relative to inflation last month. So the best cure for maintaining purchasing power and beating inflation is not staying in cash. It's not staying in the richest sector of the fixed income market, which is Treasury tips. It's being out in a full market exposure and looking for opportunities to add value on the back end of the curve, where that's been the best performance, and hedging by being underweight at the front end of the yield curve. But trying to time this market, is incredibly dangerous. Basically, people that have been short bonds, if they timed it and they sold at the very top, they have about 1% left in that trade, the best road to success in recent decades. And I think that the other thing people are missing is where are bonds relative to stocks? Bonds, I think at least are priced for the Fed rate hikes. There's a pricing of inflation, and the spread product typically does well at this point in the cycle. But equity markets are no screaming bargain. So I think, what investors could get when they go into cash and stocks, the risk is that you have a correction in the equity market and you have no diversification from the bond side.
And that's the question we've got to ask, Woody. It's a complex one too. If inflation is the risk, then the perceived risk is in the perceived risk-free asset. Then if you start to think about where I'm going to get my risk mitigation characteristics from in this market, it starts to get a little bit more difficult, Winnie. Where do you find them?
So we continue to like the high yield market, which feels a little bit scary given where we are in the cycle, if growth is going to start to decelerate a little bit, and we do have these inflationary pressures. But the high yield market of today is not the high yield market of, 2013 even, not of the mid 2000s by a long stretch. And we think that if inflation continues to chug along at pretty lofty levels for the near term, the spread product does well. And high yield is one of the few asset classes where you can make an argument that spreads should actually be meaningfully tighter because the fundamental quality of the asset class has improved pretty significantly. So as a cash proxy, if we're all sitting on a ton of cash because we're waiting for this kind of market sell-off and volatility, which is not going to materialize by definition if everybody is sitting on cash because everybody comes in relatively quickly and buys the dip, then you need to have some sort of income generation, especially when you can align it with spread compression. And so U.S. high yield still feels like a pretty good pick there. The
index level story has been one of resilience in this equity market. That's been true for much of this year. Your S&P 500 this morning, about 7 minutes in, up 0.2%. Abby, how corporate America deals with this is going to be the big focus. Morning, Abby.
Good morning, John. Well, it really is pretty interesting because, of course, inflation, as you all are talking about this morning, front and center. And yesterday's CPI number really highlighting it, growing the most since 1990. Folks are paying a lot more for stuff, but PPI up even more. So companies eating some of that. How long can that last? And it seems like Team Transitory, to your point, really needs a rebranding. At this point, it's pretty clear to everybody that it's not so brief at this point. It's going on longer and further than many had thought was possible. Now, as we all know, bond markets are closed today. A bit of a breather from yesterday's massive backup in yield in sympathy with that hot CPI number. But let's take a look at gold, the classic hedge. It's showing folks are worried about inflation. Now up for a 6th day in a row, gaining about 6% over that time period. That's the longest winning streak for gold going back to May, and the best winning streak. So again, folks are worried about inflation. And not surprisingly, if we take a look at it from a sector standpoint, we are going to see energy and the banks. Those are the two top sectors on the year. That's incredible, John. Up 52%. Energy, the most ever. Banks up 35%. But what's also really interesting, your really valuation sensitive sectors, tech and communication services trading at a greater than 25 times forward PE, they're up too. But are they vulnerable? We'll find out.
Abby, thank you. If you think about the arc of the year so far, demand has been phenomenal. We had this positive growth shock in the first quarter that everyone scrambled to adjust to. You remember the massive rally in small caps as well. What's been really, really interesting is how persistent the inflation picture has been as well. That's what surprised people. But another thing that surprised me, just how well this equity market has handled things, because these companies in America have adapted so well as well. Profitability has been great. Margins have been terrific and really, really resilient. We came into quarterly earnings expecting margins to get hit somewhat by these forces we discuss every single day. That's not what happened in the way people thought it would. Take a listen to what Citi's Kristen Bidley had to say.
We've actually seen in earnings season, the way to beat higher rates or to beat inflationary pressures is with record high profitability. It didn't happen across the board, but it was pretty impressive. And so what's going to continue to drive markets is getting away from some of the momentum trading that we've seen, getting away from whether it's COVID winners, losers. We're no longer about that. It is about a return to fundamentals.
And that's part of the reason, one piece, why this equity market's still near all-time highs. Now, I want to finish from all of you with a final comment on this. Winnie, it's a point you've made as well, just how well corporate America has adapted to this situation.
Corporate America is doing a tremendous job of really reacting proactively to a lot of the pressures in the economy. We're hearing from management teams a whole host of different mechanisms that they're using to adapt to labor issues, to adapt to supply chain issues. And I do think that that could usher in a significant boost to productivity really over the next decade or so. A lot of the things that corporate America didn't do on the heels of the great financial crisis, because there was still a lot of skittishness about the robustness and durability of the economy, are things that are being put in place right now. And so I agree that credit fundamentals and single name opportunities are really going to drive portfolios going forward. And I also think there's going to just be tremendous opportunity to align with those types of activities and initiatives.
Krishna, could I have a final word from you on the same question, please?
Sure. So I think equity markets will probably continue to do well, expected because of profitability and the adjustment that corporate America has made. But let me make one emphatic point. Given the credit growth that has taken place, if there is a drawdown in the market, the part of the market that is most vulnerable is really the credit markets. If things go bad on the inflation front and the Fed tightens very aggressively, they'll be held to pay in 2-3 years' time in the credit markets. That's I feel very confident on that assertion.
It's a big call. Robert Tipp, you get the final 20 seconds, sir.
Yeah, well, I agree with both calls, and that I think corporate credit, the fundamentals are very good, and there are definitely attractive valuations there. But I think this is the argument for multi-sector, that there are great picks within corporates across the rating spectrum, as well as in structured product and in European peripherals and emerging markets as well. So I think, economic recoveries create opportunities in bonds at that point right now.
Robert Tipp, thank you. Alongside Krishna Mamani and Winnie Caesar, working through the open and bound this Thursday morning. Good morning to you all. Coming up on the program, Academy's Peter Chip saying Chairman Powell deserves another term.
I think he should. I think he's done a very good job. I think he managed us through the pandemic. And one thing that doesn't get talked about enough, in my opinion, is he actually tried to hike rates. He tried to normalize, and he had to back off. So he's got some experience with the attempt to normalize. So I'm not sure why you bring in someone new.
More on the future of the Fed up next. This is Bloomberg.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now into weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
The Senate is, as you know, evenly divided. It's going to be important to get Republican and moderate Democrats to vote for whoever it is that the president seeks to nominate. And so I'm sure he must be thinking about the politics of who of these candidates is more likely to get relatively easily through the Senate.
Former Fed Vice Chair Roger Ferguson there weighing in on the future of the Fed. There are, it's fair to say, a lot of empty seats, some vacancies over on the Federal Reserve popping up, and maybe a few more too. Let's bring in Bloomberg's Anne-Marie Hordern for more on this. Anne-Marie, we've been asking and asking, and you know I'm going to keep on asking. When do we get a decision on this?
We just don't know yet. I wish I did. I wish one day I'll come on, John, and I will give you the decision of, and you're right, it's not just the Fed chair we're waiting on. It's 4 seats that the Biden administration has to work with. Potentially we'll get something before Thanksgiving. That has been somewhat of a tradition for presidents. He does have a little bit of time, but it is coming close to the wire if he is going to change up the top spot of Fed chair, because, of course, that requires Senate confirmation. Now, Chair Powell is widely applauded by Wall Street, backed by Treasury Secretary Janet Yellen from our reporting over the summer to keep that top job post. He has, for the most part, broad support from Republicans and some Democrats, barring a few like Senator Warren, who called him a dangerous man. And then, of course, there's Governor Brainard. Now, John, there's a narrative that's starting to be talked about, the fact that she's potentially more dovish, and right now you have this inflation data. Do you need someone that's a bit more hawkish on inflation? But there's no concrete evidence that she wouldn't. She likely sees what Powell sees, which is a dual mandate for the Fed. Robust labor market and stable prices. And during her tenure, 2014 to 2019, they were stable, 1.4% in inflation. So we don't have a lot of concrete information about how she feels about it, because during her tenure, she never had to really talk about it because it wasn't a problem. But it will be for whoever takes over that top spot.
Anne-Marie, I see you tomorrow. You know what I'm going to ask, don't you? Have we got a decision? Anne-Marie, thank you.
Maybe I'll get an answer.
I hope so. Thank you very much. Anne-Marie Hordern there, down in D.C. Mike McKee with us now. Mike, you caught up with the San Francisco Fed President, Mary Daly. Actually asked her the question, does it make a difference? Take a listen to what she had to say.
Here's something that listeners might not know, but we started out being economic historians. Let's be Fed historians. One of the things, I've worked for 4 chairs in my tenure at the Fed, and what I see each and every time is that being the chair doesn't change policy because we're always all committed. Each one of the members of the FOMC, each participant, is committed to the same thing, achieving the goals that Congress gave us, price stability and full employment, and then thinking together on how to do that. So each of the people you've named are amazing. There are lots of wonderful people out there who could lead our organization. And most important, though, is that we all are deliberating together, always on the same goals. So the continuity is of the conversation that we have, not of who's chair or not chair.
Mike McKee, that's a great message on the PR front from President Daly. I think the market feels somewhat differently about the situation.
The market certainly does at this point, although the more things change, the more they stay the same. Let me show you what I mean here. First, let's take a look at the argument for the Fed moving more quickly. In the latest CPI report, we saw a major change in the number of items that were going up in price. 100 different things in there go up in price, and that's different from, as you can see, previous episodes of inflation, and we're seeing a definitely broadening of the price pressures. Now let's take a look at a chart that would give you the Fed's argument for waiting and why it is temporary. Look at the white line. That's incomes that people got. That's the incomes people got versus the amount of spending that has been done on goods. And you can see both are coming down. All that money we got from the stimulus is starting to fade out of the economy. It's getting spent. People bought a lot of goods, which has led to a lot of backups in the supply chain. But if those things get better, and it looks like the trend is they will, then it's less of a problem and inflation may fall back. So let's see where that leaves us with the markets. And you mentioned the markets, a lot of concern about what's going to happen going forward. But if you take a look there, you can see that we have an increase in the 5-year inflation break-even, a significant increase. That's the blue line. But the white line is the 5-year, 5 years from now. And it doesn't really move up. Why? Because the market's pricing in, the yellow line there, a Fed rate increase as early as June. If the Fed does act, the market says we're not going to have an inflation problem, and somewhere in there is the Fed's argument that inflation is going to fall back anyway.
Well, the Fed acting, it depends who's at the Fed to act, doesn't it, Mike? Mike, I'm curious, and this is home bias, and I'll admit that openly. Focused on Wall Street, focused on the central bank. In the United States, it's always fashionable that when a vacancy comes up at the Supreme Court, there's a rush to fill it. And for good reason, too, I understand that. Why do we often find that party after party, administration after administration, neglect the open seats on the Federal Reserve? If you can transform that, you can do some pretty powerful things for a long, long time.
It is kind of odd because they get 14-year terms, and if they take over a term that has not expired, they can go longer than 14 years if you really want to stick around the Fed. But every administration since I've been covering the Fed, which is multiple decades, shall we put it that way, has left empty seats, and there's no real explanation for it. I suspect that Joe Biden has been sort of preoccupied by the stimulus bills up on the hill.
He's a busy man.
And also with 3 seats for sure to fill, they may be trying to put together a package that would get through the Congress.
And Mike, for a man who covered the Volcker Fed, you look young. You look very young. Your equity market up a third of 1% on the S&P. Mike, thank you. Let's get you a sector breakdown of this one with Kriti Gupta. Hey, Kriti.
Well, good morning, John. Pretty good on the index level. On the sector basis, completely different story. Energy, materials, those are your leaders for the day. To the bottom, though, you've got healthcare, real estate, utilities, even consumer staples. Those yielding sectors are your laggards. Consumer discretionary, somewhere in the middle of the pack, but with the ability to move the entire benchmark. And here's why. It has 3 major stock movers this morning. Disney to the downside in its biggest move so far since March of 2020. Tapestry soaring after reporting robust sales at Coach, and even Tesla up now that Elon Musk stock sale is confirmed to be in the rearview mirror. You can see on the chart in front of you, a lot of that has to do with that kind of big EV boom you've seen in the last month.
Oh, what a boom it's been, Kriti. That's a big focus of this show and this network. That market cap on the likes of Rivian, just unreal. Coming up, the market moving events you need to be watching. I'll get you the trading diary, the guide into the weekend and beyond. From New York, this is Bloomberg.
Talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Thursday morning. Good morning to you all. 25 minutes into the session, equities rebounding from the losses of yesterday by about a third of 1%. The small caps in vogue this morning up 0.8%. The Nasdaq up about 0.9% this morning. That's the equity price action. Here's your trading diary. What you need to be watching this morning and beyond. The US bond market closed today for Veterans Day. You'll hear from the president again, speaking at 11:15 a.m. Eastern in Arlington, Virginia. A big week of Fed speak, continuing with Williams on deck for Friday. That's an important one to hear from the New York Fed president. Plus, we get University of Michigan Consumer Sentiment Survey, and looking ahead to Tuesday, next Tuesday, U.S. retail sales. That's a big data point in focus for next week. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open with your equity market bouncing back just a little bit. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that as either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case, I mean, at least in theory.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. Because I think life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de This is not a job. If you do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.